Yes, sir. We can commence the program. We have commenced the YouTube live relay also.
Okay, sir. Okay, sir.
So, good evening, all the members. I welcome you all for our regular ACA meeting on select burning issues input tax credit under GST. I welcome the speaker, Sri Yesh Dadda sir. Now, I request our president, CA Kishore Kumar sir, to kindly give his welcome address.
Hello, everyone. Namaste. Very happy evening to one and all, and my sincere apologies for the delay caused by me in commencing the session. I hope and wish that all of you are safe, in fine health, and are happier than earlier. It gives me immense pleasure in extending my warm welcome to all of you to today's webinar. A very special welcome to the speaker of the day, CA Yesh Dadda sir from Jaipur. It appears that ACA has developed a special affection towards Jaipur because he is the second speaker from Jaipur in this month itself. Yes, just for your information, our last webinar was also addressed by another excellent speaker from Jaipur, CA Naman Shrimalji. And back to back again, we have a speaker from Jaipur. Now coming to subject proper, I remember the golden words of the then Revenue Secretary, Shri Hasmukh Adhia sir, a familiar name for almost all of us. He said that input tax credit is the sole reason why everyone should welcome GST in India. It is supposed to be the backbone of GST. At the time of launch, implementation of GST, it was also propagated that there will be seamless flow of ITC. Now the moot question is the flow seamless? Is the road to claim ITC by a registered person smooth or is it bumpy? Plus, there are so many no entries, diversions, potholes, and what not. Even after 38 months of GST implementation in India, we, the professionals, as well as the business community, are grasping with several burning issues in the claim of ITC. The speaker of today's webinar, CA Yesh Dadda sir, will take us through all these nuances and various issues, various ongoing burning issues in the claim of ITC under GST. My special appreciation to him because immediately on our request, he accepted this pleasant task, as well as because we shifted the program to the next week, that also he immediately agreed to our proposal. Thank you, sir. I also appreciate the kind gesture of CA Uttam Chand Jain, who connected us to the CSG. I welcome you once again to this webinar, which I believe will be of good use to all of us. Happy listening, and over to Secretary CA Bharat.
Thank you very much, sir. May I now request our member CA Kamlesh ji to kindly introduce our speaker of the day.
Thank you, Bharatji. Namaste, everyone. It's my pleasure to introduce today's speaker, SD Dada. SD Dada is a fellow member of Institute of Chartered Account of India, a commerce graduate from Rajasthan University, Jaipur, and a certificate holder of indirect tax course connected by ICAI. Presently, SD is associated with MS Dada & Co. as a partner and having work experience of over 10 years in the field of indirect taxation. ESG is currently engaged in handling litigations, advising clients on classification of goods and services, structuring transactions, and conducting due diligence in the field of taxation. ESG was a special invitee to the Indirect Tax Committee of ICAI for the terms 2018-19 and 19-20. ESG is also on panel of CII as a GST, Service Tax, and Excise Advisory for industry member. He has represented ICAI in the Regional Advisory Committee and Rajasthan under age of Chief Commissioner of Excise and Customs Jaipur. ESG is a founding core member of study groups of ICAI on GST, research and upgrading matters. ESG has a deep interest in academic discussion, upgradations and training. ESG has written books on principle of classifications for goods and services under GST and also on casual taxable persons for IDTC of ICAI. ESG has also actively contributed as a core member of team which has drafted technical guide on GST audit issued by ICAI. ESG has delivered lectures in northern, eastern, western parts of India and also a regular attendee on various study courses course on GST connected by BCAS, CTC, ICA, and other forums as a group leader and coordinator. GSG is an MPAL trainer on GST on for NEC ICI, Regional Trainer Institute for Revenue, and CNAJ officers and Rajasthan SGST officer. As his passion, GSG is also engaged in grooming young CA professionals of CA, CS, MBA on topic of soft skills and professional life management. I, on behalf of ACA and its member, welcome USG.
Thank you very much, Kamlesh sir. Thank you for your introduction. Speaker sir, now the floor is yours.
Thank you so much, sir. You're able to see my screen, sir?
Yes, sir. Yes, sir.
Yes, sir.
It is visible.
Okay.
Visible.
Thank you so much, sir. Respected office bearers of the association, and thank you so much for the opportunity which you have given to me to interact with all the members of the association. I'm very happy to see Rajendra Kumar sir here also, and he's such a humble personality. And because I was coming to Chennai basically before coming here, and after knowing the office bearer, before this I only knew two people. That is Uttam sir, who in fact recommended my name, and Rajendra sir. And one interaction with Rajendra sir, which I remember I had maybe some 3-4 months back, when he wanted me to write a handbook on this casual taxpayer persons for this small series of handbooks published by Indirect Tax Committee. So I somehow missed his phone because I did not have his number, and I somehow missed his call. And then just after that, the secretary from the Indirect Tax Committee called me from his phone because the number was saved. So I somehow picked that up. And Rajendra sir was witty enough to say, "Bhai, you can pick a number of the ordinary members also, so that they are also benefited." I felt embarrassed, but at the same time, I was surprised by the humbleness he carries after being at the top leadership of the institute. So very happy to have you here, and thank you to all the members for taking out time and for being part of this session on select burning issues in input tax credit under GST. My endeavor will be that I have selected some issues out of my limited experience which I have had under GST over past 2.5-3 years. And on some of those issues, I would like to present my views. I would like to present what is the view which has been taken by the department, and what are the possible options we have in terms of planning them, in terms of replying to them, or in terms of what confusions wait before us. Before I move forward, you might see this loading circle on my presentation, and you might wonder that there is some technical issue in my presentation. But frankly speaking, that's not the issue in my presentation, but that's how has been the state of GST as of now, ever since it has been implemented in India. And all of us know that it is still at the implementation stage. We cannot say that now it has stabilized. And in fact, what has happened in the last GST Council meeting, maybe for the first time, we have realized that the concept of cooperative federalism, for the first time, there was some political statement which came in public where in terms of the sharing of revenues of compensation cess, center had a different version and the state finance ministers had a different version. Where it is going to take us, what is going to happen, that only time will tell us. But yeah, the way it has been moving, or the way it has been implemented, in a sense, all of us know that it is good by soul, but all of us also understand that the process of implementation and the glitches which we face, we cannot say that we are by any chance we are near to that point where we can say that probably this law is going to settle in couple of years to come. So we are going to see this loading for some time now. Before I go to the topic, and because we have this wonderful opportunity to come up to connect with each other, and in fact, just before me, as the chairman was explaining, that Naman took a session, and he's a very dear friend, and he did tell me that how was his session, how long did he take it, and all those things. But the point is that this wonderful opportunity of connecting a member sitting in Jaipur with all the members sitting in Chennai has come because of this use of technology. And we can say this has come because of this COVID situation which we have, though which is there is nothing in this situation of which we should say that it gives something positive. But yes, as a professional and specifically as a chartered accountant, where we are known for implementing things even in the difficult situation, we are known for adapting in difficult situation. Probably some of the myths which have been broken in last 3 or 4 months, I'm sure all of us would have realized. Like one of those things which at least I have understood in my office or in the professional environment where I work is that the investment in human resource is not enough. Probably the size of investment in the infrastructure would now has to change, and now we don't only need the human resource, but we also need to invest in their motivation level only, so that we'll be able to actually ensure that the quality of the service which we provide and the experience of service which we give to our clients is something which is worth remembering, because that's only now would be able to help us in generating and getting to new avenues. But I think the most important thing out of this, and if we try to connect three unconnected dots and we try to build something out of it, that is the technology, GST, and COVID situation. And we realize that all these three things, the way they have come, the way they have impacted our lives, probably we were not ready for it. We were not ready for the technological changes which have happened in last 10, 15 years. But somehow, at least today, all of us know that it is very important for us, and we somehow cannot avoid it. Similarly, GST, I was one of those people who was not sure up till 30th of June 2017 whether GST would actually see the light of the day, whether it will actually remain here. But now at least I have also understood that it is here to stay, and it is going to be there with us for a long period of time. And it is better that we adapt our understanding accordingly, and then only we advise our clients. And third is this COVID situation, where it has been only a matter of 3-4 months, but suddenly there has been a realignment in everything which we have done. And with all these things, maybe technology in last 10-15 years, GST in last 3 years, and this COVID situation in last 3 months or so, probably the way forward is that things are going to remain uncertain now. And if from these instances we can learn that uncertainty is the new certainty which we have, and if we are ready to adapt ourselves in the uncertain environment, if we are ready to get ourselves comfortable in the uncertain environments, then only probably we would be able to do better than the ordinary people who are around us. So with this background, when I come to my topic of input tax credit, and when the chairman pointed out by saying this, that the then revenue secretary said that input tax credit is the reason because of which people should welcome GST. Now, whether it is seamless input tax credit or it is actually see less input tax credit, that is, you would be able to see lesser and lesser of the input tax credit over the period of time, is something which probably you and me would witness depending upon how things pan out post this COVID situation, and once the operations would start completely, both from the revenue side and from our side. And when we see the notices, when we see the things happening, when we see the advanced rulings coming, when we in fact see some of the court's judgment coming, we realize that the concept of input tax credit, which was propagated as to be seamless, there are still some technical issues in it which needs to be addressed, and there are something and there are some concepts on which the interpretational clarity is required. But before we deep dive into the specific section, and we dissect it and look for some answers for it, on a conceptual understanding, what basically we understand is that input tax credit, it can be divided in three baskets. One is the idle input tax credit, where we say that I have paid the tax today, I'm entitled to take benefit of it right now, and whether I will be able to basically monetize it by not paying my outward tax to the extent of tax which I have instantly paid. And that's where I think, as a tax professional, as a consultant to the client, that's our focus always is. We try to read we always try to interpret the provisions in a sense where we are able to maximize the idle input tax credit for the clients, and that's how we structure the transactions. Whereas we have the second basket, where majority of the input tax credit actually sits in. So one is the idle situation, and all of us know that nothing is idle in this world. But yeah, the float credit is that credit which is available to an assessee, but It might not be available instantly. It might not be available across India. It might not be available maybe for the specific transaction, but can be used for some other transactions. And when we see the provisions like 36 subsection 36(4), that rule 36(4) of that matching with GSTR 2A, when we see those provision of 16 subsection 4, we realize these are all those credits which are float credits, where I would be able to claim them, but maybe there is going to be a timing issue, maybe there is going to be some geographical restriction. And third is that worst credit, where our endeavor always is to ensure that our credit does not fall in this basket. And obviously the other side, which is standing at the other end of the rope, they have this concept of finding out that what is that list of block credit, can they really read it in a sense that it can be expanded. And our understanding always is how can we read it so that it is always restricted in nature. And the whole fight of input tax credit, which is typically known as the soul of any indirect tax, is about where are your majority credits lying, in which basket can you basically say that your credit is there. It is in the idle basket, or the float basket, or the worst basket. And we'll try to pick out issues from around these concepts only. Now, before we go to section 16 and find some specific issue, we have these two definitions which are very interesting definition. One is of input tax and second is of input tax credit. I'm sure all the members are aware about this, but before we actually look at the definition, one question which I would like to ask each one of you, that is, I'm sure all of us have faced issues specifically while doing the annual compliances of GSTR 9 and GSTR 9C, that during the course of reconciliation, we realized that a client has taken input tax credit of IGST. He should have taken the input tax credit of IGST, but he has in fact taken that input tax credit as CGST, SGST in his books of accounts and in his GST returns. And now we are wondering what suggestion we should give to the client, whether we should ask him to actually reverse that CGST, SGST and take the IGST. And then looking at the time restrictions we have for availing of input tax credit up to a certain period, whether that will be possible or not. Or just because that GST, which has been bifurcated into three baskets of CGST, SGST, and IGST, because the credit should have been put in a specific basket and it has not been done so, but it has been done in some another basket, am I really required to reverse that? And I think the answer to that comes from how do you interpret the provision of section 262 and section 263 in this regard. So basically what 262 basically defines is this, in what is input tax. And when you read the definition of input tax in the CGST law, so mind you friends, I'm not talking about the definition of input tax in two separate legislations as CGST, SGST. But when I talk about the definition of input tax from the point of view of only CGST Act only, we realize that input tax from the context of CGST is not only the credit is not only the tax of central tax, but in fact it is a tax which includes IGST also, it includes the tax which is state tax also, and it includes other taxes which has been paid in form of import of goods and reverse charge and otherwise. And together this basket is called as input tax, and when somebody takes credit of it, that becomes the input tax credit. And then when you correlate it to section 16 of the CGST Act, or if in case you're reading any specific state act, you realize that section 16 talks about the entitlement of credit of input tax. It doesn't talk about the credit of input tax of CGST. It doesn't talk about the credit of input tax of IGST. It doesn't talk about the credit of input tax of SGST. So even if there has been a situation where somebody has actually mistyped something, there has been a situation when somebody has actually wrongly punched some information, or there has been a situation when we have a wrong invoice where the tax should have been something else otherwise, but because it has been wrongly mentioned in the invoice and because of that wrong credit has been taken, probably a view at the inception can be taken on the point of view of the way definition is worded, that even if I am required to reverse it and I am required to take it, ultimately it is going to be a revenue neutral exercise. And if the time limits for actually making these corrections of taking the credit and reversing it has passed, and now I cannot take any necessary action in my books of accounts or in my GSTR 3B, can I really look at it from the point of view of the definition which is there? Can I look at the concept of revenue neutrality? And on the basis of it totality, can I take a view by saying that I would not make a correction, I would make a necessary explanation, and on the basis of it, I would go further. So this concept, when you keep it in mind, that the way definition is worded and the definition of input tax credit of CGST is not worded, but it is like input tax, which means CT, ST, and IT together, which includes everything else. Probably from that point of view, we realize that it has to be interpreted at a broader level, but not by bifurcating into three separate views. And from this, a very interesting point which comes up again, an issue which all of us face generally during the course of audits, and honor of that these are one of the primary or prima facie issue which crops up, that let's say I have supplied any goods to somebody who is sitting in Maharashtra. Technically, I was supposed to charge IGST with place of supply as Maharashtra. Because of lack of understanding, I did charge IGST only though, but the place of supply was wrongly mentioned as maybe, let's say, Tamil Nadu, but not as Maharashtra. Now, the person who is sitting in Maharashtra, when he has my invoice and when he's looking at the invoice and he realizes it is IGST and he has taken the credit, when tomorrow he goes and files his GSTR 9, and when he goes to the table which is known as table 8, which reconciles the input tax which is being reflected in GSTR 2A vis-a-vis the credit which I have taken in my GSTR 3B, he realizes that table 8A, which auto-populates the amount of input tax which is coming via my GSTR 2A, it will not show that credit where the place of supply would not be Maharashtra, because it will automatically remove it from 8A. In fact, one of the recent utilities which has been developed on GSTN portal, now we can see the invoice-wise details which come in our table 8A, that is auto-populated details of 2A, and we would be able to identify that wherever the place of supply on a specific invoice doesn't matches with the state in which the person who is taking the credit is registered, then it will not auto-populate in 8A. And this somehow kind of gives us an indication whether I was not entitled to take that credit of IGST where the place of supply did not actually coincide with the state in which I am registered. Now, friends, when you would read the respective CGST, SGST, IGST laws, I am sure all of us would be very clear in identifying this, that there is no provision in the law which basically restricts this credit. In a sense that if I was entitled to take credit of IGST, even if the place of supply on that invoice is incorrect, my claim of input tax credit cannot be taken away. Though in the state in which I am, that state might not get the necessary share of tax, but that is something which I should not be bothered about. However, when I go to GSTIN, that is goods and that's the network through which we do the compliance. And when I go to the network and when I try to see there and I cannot find auto-populated details there, I realize that GSTN law. Friends, I'm using the word GSTN law, and there is no law as such called GSTN, but that's a self-imposed law which comes from how you interact with the portal and what portal tries to tell it to you. So from the portal, you realize that the portal doesn't allow us to say that we will treat it as a match credit. So the whole point of saying this is that there is no provision in the law which says that because of wrong place of supply, you would not be entitled to take input tax credit. And hence, all of these things which are happening on the portal, they are not inconsistent with the provisions of the law. And obviously, the law which has been enacted by the parliament would always be at a higher pedestal rather than something which has been done on the GST portal. So there is no provision in the law basically which restricts this. Let me take another example for which probably we can have a difference of opinion, but still, I think the opinion which comes out from which is evidence based and comes out from the provisions of the law, that should always be favored. And that is, if let's say I come to Chennai, I stay in a hotel, and that hotel charges me CGST and SGST, which they are actually required to do so. Can I come back to Rajasthan and take that credit? The obvious answer would come as no. In fact, in one of the cases of advance rulings, where an advance ruling was filed in Rajasthan only, and this question was asked, the advance ruling authority, and in fact, the appellate authority said that neither the credit of that CGST and the credit of SGST, which has been charged by the hotel sitting in Tamil Nadu, can be taken by a person who is sitting in Rajasthan, because I am only entitled to take credit of IGST if any invoice is coming from outside the state of Rajasthan. The point is, when you again try to go and find out and read it from the provisions of the law, you realize that for the perspective of CGST, if on a linear understanding only, I go and read the CGST law, CGST law doesn't in fact restricts me in doing so. In fact, a slide before, when you read the definition of input tax, you realize that the tax which is called as central tax is input tax, and credit of input tax is called as input tax credit. So I am very well allowed to in fact take that credit of CGST which has been charged by the hotel. Can I take the credit of SGST also which has been charged by the hotel? Again, the logic would tell us, no, it is not possible because the tax has never flown to the state of Rajasthan. But again, when we are reading the law, the logic, though it has importance, but it would only come into implementation when you are unable to literally interpret the provisions of the act the way they are worded. And when you literally read the law, you realize that again, the definition which I just talked about of the input tax, it says it includes the SGST also. And for SGST, the definition of SGST Act says that whatever tax has been paid under respective state acts, and it doesn't refer to. So when I'm reading a CGST Act, and in that CGST Act, when I'm referring to the definition of state tax, and then when state tax definition basically says that you are entitled to take credit of state tax which has been paid under the provision of the specific state, then can I not take a view by saying that even I'm entitled to take that credit of SGST through provisions of the CGST Act, and what stops me? Probably all these things have to go to the court of law. They have to be tested. Again, I would again say that by logic, SGST, probably I should not be able to take credit, though it is a cost which I have borne. But as per the structure of the law and the federal structure of the country, I should not be able to do that. But there is no provision on the law which restricts my credit of CGST. And hence, probably in that sense, as a prudent professional, I would tell my client to take that credit of CGST today, reverse that credit, and then to wait for maybe for myself to go to the court or somebody else to go to the court, and maybe 2 years, 3 years, 4 years down the line, if somebody gives a favorable judgment, I would be able to in fact take all those benefits back, subject to that I have taken the initial claim within the time limits which was given under section 16 subsection 4. With this, when I come to section 16, and I would not read the way the section 16 is written, because I'm sure all of us have read it hundreds of times, but I will try to pick up some specific points which comes out from this. So all of us know that 16.1 basically talks about the entitlement and the eligibility of the input tax credit. And basically it talks about 3 things which a person is required to take care of. That is, the tax should be charged on the supply. It doesn't uses the word inward supply, but that's what all of us understand, that we're taking input tax credit on the inward supply. And that supply should be used or intended to be used in course and furtherance of the business. And we realize that in fact that actual use at the time of entitlement is not important, but in fact if I have an intention to use it at a further point of time and it has connection with my business, then definitely I am eligible to basically bring that in my electronic credit ledger. The important point here is that when it talks about the in course and furtherance of the business, there is this word which is called as his business, and this his has some relevance. So what is this relevance? That what difference it would have made if in case it was written like in course of furtherance of the business, and because it is written that in course and furtherance of his business. So there is this view which is emerging out that, let's say there is a situation where there is a factory in Rajasthan and there is a factory in Chennai, and let's say there is a head office which is there in Mumbai. Now the head office in Mumbai is not doing anything except that the management is sitting in that head office, and it receives certain invoices of input services and some inputs of which it is taking the credit. The point is, because it does not have any outward supply, it is wondering whether it is entitled to take the input tax credit or not. So without going into that concept of cross charge as of now, the first point of contention which is coming is, how is the Maharashtra state office of a particular company which has 2 factories, one in Rajasthan and one in Chennai, is entitled to take the credit because it is not doing any business. And in fact, whatever credits it is receiving, that is in course and furtherance of the business of Chennai or Rajasthan, because they are distinct persons. And there probably we have to understand from the point of view of what is the definition of business which is given in the law. And when we go to the definition of business, we realize that business does not only mean trade, commerce, manufacture, vocation, but in fact includes all ancillary and incidental activities in relation to trade, commerce, manufacture, vocation. And in that sense, whatever incidental activities that head office is doing, sitting in Maharashtra That's precisely is regarding though that credit has an attribution towards those incidental activities, and there cannot be any question that it is not entitled to take the credit. So in that sense, that even if this his would not have been used, even if we have this concept of distinct person, even if where we try to bifurcate one company into separate registrations and separate persons, still any credit which is coming in at any point of time in any of the registrations, till the time it has nexus with the business of the company as a whole or the person as a whole rather than that distinct person, there is no restriction in section 16 subsection 1 to take that credit. With this, when you come to 16 subsection 2, all of us know that there are 4 conditions, and one of those conditions is that the person should have received goods and services. And to this, we all of us understand that receipt is something which is not a complicated concept. So there is nothing in this on which somebody has to actually deep dive and delve into it. But because, and I think chartered accountants can understand this better as compared to any other professional who probably do not have access to books of accounts as much as we have. And we understand that when the concept of receipt of goods and services, it doesn't come just like that. I can demonstrate it. See, these are the goods lying there and I have received them. It comes from a well documented process for which in fact we give our services in form of internal auditing or setting up of standard operating procedures and whatnot. And when I try to in fact bring all these 4 conditions, that is receipt of invoice, receipt of goods and services, payment of tax by the supplier, and filing of return by the person who is taking the credit, you realize that it is a complete process in itself where a lot of activities are involved. And out of those activities, you have to pick one of those things where you would be actually able to explain it to the outer world that by this event, I actually mean that I have received the goods. By this event, I actually mean that I have received the invoice. So when I take this example, you see that in what happens in a comparatively medium size or a big size organization, that there will be concept of purchase requisition or a purchase order or a work order which is being awarded to a supplier or a vendor, and against that the supplier or the vendor would actually issue an invoice or an e-way bill, and along with that there will be an LR copy. So probably LR or that consignment note concept, maybe it does not have a mandate from the point of view of taking credit in the from the section 16 of the GST Act, but from the point of view of the books of accounts, from the point of view of the statutory records, all of us understand that LR, which is being basically issued by the transporter, is a very important document. And with these 3 documents, probably goods, if I talk in context of the goods, those goods would come to the factory. Now, just because they have been dispatched and they're standing at the factory gate, one cannot take a view that they have been received. In fact, those goods might be lying in my factory since last 10 days. But my factory manager has not done the QC. My factory manager has not done the gate in entry of it. My factory manager has not done the material in entry of it. Till that time, whether I'll be able to actually substantiate it from my books of accounts that I've received the goods or not, probably answer to this would come from a professional by saying that till the time my books cannot substantiate it, even if physically I have those goods, it would be very difficult for me to substantiate that point. And then once the goods are received, then we have this concept of matching of PO, invoice and GRN. Then we say that, okay, the matching has happened. And then we satisfy the second condition that, yes, now I have received the invoice. So probably somebody would say that the invoice has been couriered to your office. Our accounts person has received it. He has the envelope which is lying with him, but the envelope is not open. Envelope is open, but it is not entered in my books of accounts. Until the time I have not entered that invoice in the books of accounts, can I really say that I have received the invoice with me? Probably again, that's a thought to ponder upon. And then we go and do a GSTR 2A matching, which kind of, though it has a very difficult time to sustain in the court of law, whether I have to prove that supplier has paid the tax or not. But from the compliance point of view, then we do a 2A matching and then we file the return. And that's the 4th step where we are able to identify the 4 conditions. So in this slide, probably you're able to see 8 steps. Out of these 8 steps, we realize that the 4 steps which government is asking us under 16 subsection 2 are somewhat sandwiched between the other 4 steps which are there. Either they are precedential steps or they are the subsequent steps. Now in this background, we have this section 155. And what does section 155 says? Section 155 says that the onus of proving the receipt of goods or services lies on the person who is basically taking the input tax credit. So tomorrow, if the officer has to issue a show cause notice upon me, and he wants to issue a show cause notice that I have supplied some goods on which I have not paid tax, the allegation has to come from his side. The allegation it cannot be that I cannot tell him that no, you first of all tell that I am first of all required to say that why I have not paid tax, but you have to basically bring the allegation that why I was required to do that. But this theory doesn't hold good in case of input tax credit. In case of input tax credit, I can always be asked by the proper officer whether I have discharged the owners of proving that I have received the goods or not. And from that point of view, realize that when we talk about the accounts and records, probably in terms of goods, how are we going to prove that we have received it? So we might do a three-way reconciliation of invoice, e-way bill, and goods receipt note. And up till now, maybe e-way bill, it might not be a final evidence to say that I've received the goods. In fact, without e-way bill, I might have received the goods. I might be able to prove it from my books of accounts, but still it may raise a suspension. But in this background, when somebody is maintaining such books of accounts properly, let's say a situation arises where I am importing some goods, and let's say those goods are at the Mumbai Nhava Sheva port, and I have a factory where I am in Rajasthan. What I generally do is in my accounting software, be it Tally, SAP, or any other accounting software, I make an entry of receipt of goods in my books of accounts. But tomorrow, those goods which I've imported, they are lying at the warehouse in Maharashtra. That's, let's say, the custom bonded warehouse. I find a receiver of those goods, and he says, you deliver the goods to me in Mumbai, in Thane only. That's the part of Mumbai region only. Why do you want to take those goods to Rajasthan first of all and bring it back to me? So you can make a direct delivery from there. Now, can I make a delivery from there or not is a separate question, probably not for discussion today. But let's say I take a conscious call and I make an invoice from Rajasthan and directly dispatch the goods from there. The point is, when I'll be taking that credit of input tax credit of the tax which I have paid on import of goods, the question which will come up basically is that whether I have received the goods or not. And I would say, yes, definitely I have received the goods because I have cleared the bill of entry. The point is that should come from a books of accounts. And when I say it should come from the books of accounts, what practically it means is, even if I am saying that I've made a constructive delivery of the goods, that concept of constructive delivery should somewhere be recorded in my books. I should be able to demonstrate that how do I record constructive delivery. And once my record of constructive delivery is there and it is proper, then the onus lies with the department to say that I have not received the goods. So I think this is one point probably where our role comes in, where we tell our clients very clearly that all those goods which are lying with the job workers, all those goods which are lying with the agents, all those goods which are lying with the customers for the purpose of testing, or all those goods which are lying with CHAs when they are imported and all those things, we have stock records maintained for them. They may not be the goods which are in my physical control, but still these are those goods which belong to me. They are part of my stock records, but they are recorded somewhere else, and they are important. Why am I bringing this point here is this, because I'll take you to accounts and records only in this regard in couple of minutes. But before that, I want to bring a connected point related to this. So what we generally do is, and in a lot of industries, this happen that we have this transaction loss, we have this normal loss, or we have this transportation loss, where I know that if I am ordering 100 liters of, let's say, some liquid for the purpose of my business, there'll be a transit loss of 20 liters. And once that transit loss of 20 liters would happen, I'll be making a payment of 100 liters only to the supplier. And the supplier will charge tax on 100 liters only, but I might not be able to actually receive whole 100 liters. I might only receive 80 liters in my factory. Now, the point is, how am I actually going to record that in my books of accounts? Am I going to record it as 80? I am going to record it as 100 minus 20, or I am going to record it in some another manner. And let's say, to complicate it a little further, out of that 20, I am able to bifurcate that in three parts. What is the tolerable loss? That is the natural loss which happens. Let's say that is 5 liters. Second is a non-tolerable loss due to some specific reason of negligence on the supplier's part, or maybe on the transporter's part. Let's say that is 12 liters. And then there is a replay out of that 12 liters. Let's say the supplier has agreed to replace the 4 liters. Now, in this case, can I actually take credit of 100 liters? Can I only take credit of 80 liters? Can I take credit of everything except this non-tolerable loss of 12? How would I look at it? Again, that would come from how am I basically preparing my books of accounts and my records. In a simple sense to say that when my accounting process clearly identifies that for my manufacturing, I need 80 liters of that liquid, and for 80 liters of liquid, I know the business precedence that I have to order 100 liters, and I know that I have to make payment of 100 liters. Then basically whatever price I'm paying for 100 liters is actually price for 80 liters. But if I know that out of 80 liters, 12 liters is that something which is non-tolerable, then in that case, definitely I'm not entitled to take credit of those 12 liters, because either they should be replaced, or even if they are not replaced, that is something which is not part of my manufacturing process, or that is not part of my business activity, but that's an exceptional event which has happened, and I cannot say that I've received those goods. But whatever tolerable loss has happened, and if it was my responsibility, which was known both to the supplier and to the receiver, then I don't see a problem that I should not be able to take that credit of 5 liters. But yes, how do I record that in my accounts and records would be the correct way of putting it forward to the outside world, maybe to the department also. If let's say out of the 12 liters, 4 liters will be replaced, then in that case, that 4 liters I will be able to take credit, but not today. Only when I'm going to receive those replaced quantities, then only I'll be able to take credit in that regard. So we realize that how are we receiving the goods and how are we receiving the invoices? Though I am entitled to take the credit, now in these three cases, out of those 20 liters, 5 liters, which is natural, I'll be able to take instantly. Out of those 12, 4 I'll be able to take only when I receive the replaced quantity, and 8 I will never be able to take the credit, irrespective I make a payment of whole the amount of tax in this regard. And for all this discussion which I've been making, the focus of saying all this is to bringing you to this provision of the Act, which is very important. So all of us know that we have section 35 under CGST and respective SGST Acts. Basically, 35 says that there are certain accounts and records with any registered person is required to maintain. Now, all of us know under GST, we have this concept of supplier and recipient, the concept of trader, manufacturer, service provider. All these concepts have vanished, and there is no requirement as such to actually identify them separately. But when you go deep down into the provisions, when you actually go into the specific rules, when you read rule 56 along with section 35, you realize that record doesn't work in that manner. In fact, something which you see in red here is very interesting, and to my limited experience, what I have been able to understand is something which has been ignored post GST. So there is this requirement of a production register under GST, where it says that quantitative details of raw material or services used in manufacture of goods and the quantity of goods manufactured, including waste and byproducts, is required to be maintained. Similarly, in case of a service supplier also, there is a requirement that whatever inputs has been used in provision of the service, same is required to be maintained. Now, in this background, when you look at the earlier situation and when you read this provisions, and let's say there is a departmental audit which is happening in your client's premises, and they say, okay, we need the production register. And then when they go through the production register, you are able to demonstrate that, see, this is the amount of inputs which we have used. They would definitely be interested in knowing that what you have used, what is the amount of wastage which you have calculated, is that a natural wastage, and whether that wastage is corroborated by the other evidences which are available under other acts. And once we are able to demonstrate that, then probably in that sense, we would be able to explain that tolerable loss or whatever quantity of tolerable loss was there was actually part of my cost. I have actually indirectly used it to manufacture this amount of finished products which you wanted to look at. What would happen if I fail to produce these records? If I fail to produce these records, though directly my input tax credit cannot be reversed, but yes, there can be a question on my books of accounts. And once there is a question on my books of accounts, then I can be basically asked under section 155 that I have to basically discharge the owners that all those good services which I am saying that I have received for providing the outward supplies, I have to in fact identify them and I have to prove that they have actually been received by me. So the point is that these account records, they are somehow still on the older concept. They somehow have to in fact match with the way we are keeping the records and other provisions of the act. And if we are not accounting for the wastages, or we are not accounting for the transit losses, it kind of creates an issue for us. With this background, now when we come to some specific issues, again in respect of those goods and services only on which I have taken the input tax credit, and let's say there are some subsequent events which are happening. So all of us know there is a schedule 1 which has entry 1. Schedule 1 is regarding those supplies in which there is no consideration, even if those activities or supplies are treated to be taxable supplies under GST, and there is a mechanism for giving the valuation that is given under the law. Now, when you read the entry 1 says permanent transfer or disposal of business assets where input tax credit has been availed on such assets. And now the question comes is, let's say I have manufactured some inventory, I have finished goods available with me, and now those finished goods have become obsolete or they're outdated, and now I want to scrap them, and I don't want to sell it to anybody else because that will not fetch me any handsome amount of money. So I want to basically dispose them. I want to just give them away to somebody else. Now the question which will come in this case is, I have my finished inventory, whether that will be covered by this entry 1 of schedule 1, where it says permanent transfer or disposal of business asset where input tax credit has been availed. Or you take example of business assets, that is whether business assets, can I say inventory is my business asset, or can I say the capital goods which are defined under GST, that is all those goods which are capitalizing in my books of accounts, that is only business asset? Or is it talking about traded goods also, or it is only talking about traded goods? So we have these 3-4 questions with us. And then a lot of people basically say, no, everything. In fact, the finished inventory, the business asset, the traded goods, free samples, everything, whenever you're giving them at free of cost, they are covered by this entry 1. Why? Because we have this rule 30. So tomorrow you cannot say, okay, what is the amount of input tax credit which I took on my manufactured finished goods? So what I'm trying to explain here is friends, let's say I am buying raw materials, I'm converting a finished goods, and let's say I'm scrapping the finished goods. The question which will come is, what is the amount of input tax credit which I took on those finished goods? And if I have taken input tax credit on those finished goods, then am I required to reverse here? People say there is this rule 30 which says wherever there is a problem in valuation, then you can always value at the cost plus 10%, and then we have costing accounting standards. But before basically going into valuation, what is important is how you read this entry. And this entry basically talks about 2 filters which are important. One is it has to be a business asset. Probably a lenient view can be taken in this regard, that business asset would probably include everything which you have not shown at least as a consumable. That means the stock of which you are not maintaining, but anything of which you are maintaining as a stock item, be it a capital goods item, be it a fixed asset, or be it anything else, that can be treated as a business asset. But the later condition is important, and that is something which probably the application of mind is required. That is, input tax credit has been availed on such assets. And when you read this, you realize it uses the word on. It doesn't use the word in relation to, it doesn't use the word in respect of, but uses the word on. And it says if you have taken credit on those assets, then only basically you're required to treat it as a deemed supply if you're disposing them or permanently transferring it. So whether I have actually taken input tax credit on my finished goods, the answer is absolutely no. I have not taken input tax credit on my finished goods, but actually I have taken input tax credit on the raw material, and because I'm not disposing the raw material, hence I am not covered by this entry 1. So all the manufactured inventory, at least they're not covered by this. Maybe they can be there can be a view which can come that if it is not covered by this, why not you cover this in 17.5H, which talks about reversal of input tax credit. And it says that it is notwithstanding anything contained in 16.1, whenever basically any input tax credit which has been taken in respect of goods which are lost, stolen, destroyed, written off, or disposed of by way of gift of free sample, you're required to reverse the input tax credit. So, okay, you don't pay any tax on the outward supply as a deemed outward supply, but at least pay some tax by reversing the input tax credit. The question in this case would come is, how do you again read entry this section 17 subsection 5? Because 17 subsection 5, the way it is worded, it says notwithstanding anything contained in subsection 1 of section 16 and subsection 1 of section 18, input tax credit shall not be available in respect of following goods. And when you read in respect of, we realize we have to interpret what is the meaning of in respect of. I'm sure you must have heard it earlier from any other speaker, but it's a relevant judgment which we need to quote here, that what is the meaning of in respect of. So this phrase has been interpreted by the Honorable Supreme Court in case of Swastik Tobacco Factory. This judgment is in context of excise only, and this was basically in context of an exemption, and so whether that exemption is applicable on specific goods or not, and the way it was worded was in respect of these goods. And in that case, Supreme Court said that in Indian context, in respect of has to be read in a very narrow sense, and in respect of is actually synonym of on. So exactly the way the entry 1 of Schedule 1 is worded, when it says input tax credit on business asset, in an exact similar manner in 17.5H, this respect of, in respect of should be actually replaced with on. And now when you read with on goods, it again brings us to that point that in fact manufactured inventory, if it is given as gift, if it is given as free sample, even if it is destroyed or it is written off, you are in fact not required to reverse the input tax credit in that case. So neither you are required to pay tax as deemed supplies under Schedule 1, nor you are required to actually reverse the input tax credit under 17.5H. And by all this, basically, we realize that in both the places, there is no implication at all. In fact, one additional point which comes here, which is useful for us to consider, is that somebody would say, okay, I don't want to go in this problem of what is in respect of on and all those things. I just want to pay the tax and I want to reverse the credit. But the question will come is, how will you reverse the credit? Because you don't know how much amount of input tax credit has been taken on manufactured goods. Then somebody would again say, Arey, there is a rule 30 which is there, and that rule 30 says that it has to be cost plus 10%. But mind you, friends, that rule 30, which talks about cost plus 10%, is actually prescribed under 15 subsection 4 of the Act. And 15 subsection 4 is basically for identifying the transaction value for paying tax on the outward supplies. We are not discussing the payment of tax on the output supplies. We are discussing here the payment of tax from the point of view of reversing of input tax credit, and hence those valuation provisions cannot be made applicable. So even if you take a view that there is a requirement of reversal, there is no valuation mechanism. And we have a Supreme Court judgment which says in case of BC Srinivasan Shetty, that's an income tax judgment. I'm sure all of us are aware. It says once you do not have a mechanism to compute tax, then in that case the levy would fail. So in this case, even if you're required to reverse on manufactured samples, you are not there is no mechanism given for that. However, when I speak all this, it is very important that I bring out that though the understanding of department officers at least is not aligned to what I have been speaking, because there is this circular number 72/46/2018. It came in the light of the it came in light of the medicines which are expired medicines, and the expired medicines which are being basically given by dealer back to the manufacturer. Then in that case, the question which came was whether manufacturer is required to input tax credit. Now, if the logic which I just explained is to be applied, then he is not required to do that because he has manufactured a finished goods and he has taken credit on raw material. But this circular clearly says that yes, manufacturer will be required to input tax credit. The circular doesn't say how will he identify the value, but circular is only restricted on the point by saying that he will be required to reverse the credit. To what extent the circular is correct, to what extent how we are going to apply it is something which has to be left for the professional discretion of the members only. Then when we talk about the reversal of ITC on the sales promotion items, where I am giving some sales promotion items to my customers, to my other prospective customers and everything, can I say that whatever I am giving as a sales promotion, mind you friends, I'm not giving as a sample. So these are not samples. I'm not destroying them. I'm not writing them off, but I'm giving them as sales promotion items. Can I say they are gifts? I think we have a lot of judgments to say what are gifts, and gifts are basically, they are something which are result of a gratuitous act. Definitely anything which is given as a sales promotion item, there would be some understanding of the person to whom it has been given. Either he will win it in some contest, or either he will be my existing customer, or he will be basically has entered into some contract with me at some point of time. And because he would have entered into some contract with me at some point of time, I want to basically give him some incentive in that sense. And that's why I'm giving him this sales promotion item. So again, when you read 17.5H, you realize you do not find an appropriate word under which you would like to classify the sales promotion items as gift of free sample. And even if these gift of free samples have been bought out items, these are not manufactured items, but these are bought out items, even in that case, there is no requirement to basically reverse the input tax credit in this regard. At least 17.5H will not come into picture. In fact, we have a judgment of tribunal in this regard in case of Surya Foods and Agro Limited. And this judgment again was in context of excise duty by saying that whenever some items are given as free, so those items are nothing else but their discount, and on that discount you cannot that cannot be made part of the transaction value. So in fact, on the outward side also, we have some precedents to say that you need not unnecessarily load the cost of these items to the valuation for the purpose of levying tax. And friends, all of us understand, because we are not attributing any consideration to these items, so on free supplies, until unless they are covered by Schedule 1, there is no requirement to basically input tax credit. So hence these are technically free supplies, and hence there is no requirement to pay tax on the outward supplies also. But when we come to the context of capital goods, and up till now whatever I was speaking was manufactured goods, traded goods, samples, or sales promotion items. When I come to the context of capital goods, the concept is little different, because we have another provision 18 subsection 6, and it says that whenever somebody is supplying capital goods or plant and machinery on which input tax rate has been taken, then there are two ways on which you have to pay tax. Either you will pay tax on the transaction value, that is on the outward value, whatever has been decided, or you would reverse the input tax credit on the basis of a specific formula that we are going to prescribe through the rules. And basically what that formula from the section it comes out is that there will be some percentage point for each quarter. So whatever credit I have taken from some one specific date, for each quarter I am going to reverse that 5% input tax credit, and on the basis of whatever okay, yeah. So whatever credit is left over, I will be basically required to reverse that input tax rate. So that's what the provision says. The point is here, the problem is not in the provision. The problem is there in the rule. And when somebody who is reading the rules for the first time and he has read 18.6, he has understood, okay, now I'm reversed. I have to identify whatever reversal of credit I'm required to do. He would go and find and read the rules. When he'll read rules, he'll realize there is this rule 40. And rule 40 says manner of claiming credit in special circumstances. And then you would understand by the heading, probably this is not the correct rule for me, because this rule says manner of claiming credit. We are talking about reversal of input tax credit. But friends, when he will read this rule, he will realize this rule is basically under 18 subsection 6. And this rule says that whenever you are basically supplying capital goods, then you have, whenever you have to calculate the reversal, it has to be 5% for the each quarter or part thereof. But the story doesn't end here, and we have one more rule, rule 44. And this rule 44 says manner of reversal of credit under special circumstances. And this rule says, okay, whenever you are basically capital goods, whatever life, or you have to identify the useful life of the capital goods, and whenever they are being supplied, so whatever is the useful credit which needs to be reversed, how are you going to calculate this? So this doesn't talk about a 5% per quarter, but it says whatever number of months are left divided by 60, because the life of capital goods is assumed to be for 5 years, that is 60 months. So whatever months are left from the date of sale up till the useful life divided by whatever, divided by 60 into total amount of input tax credit which has been availed, whatever figure comes, that's basically the amount which comes under rule 44. Now friends, if you will try to do calculation as per rule 40 and rule 44, and there is an instance where let's say the goods are not sold in the last month of the quarter, but if the goods are basically sold in any of the first or second months of the quarter, you will realize there will always going to be difference in the calculation as per rule 40 or rule 44. As per rule 40, you would always have a case where reversal would be higher, whereas as per rule 44, reversal would be lower. And then you would wonder basically which rule you would like to follow, 40 or 44. Again, the conservative person and who would not have a bigger hole in the pocket just by following rule 40, he would like to follow the rule 40 and not go into litigation, but where the amounts are substantial. Probably in that case, we realize that we have been confused whether we have to follow rule 40 or rule 44 in this regard. So we realize in case of supply of capital goods also, the point is, though the section is clear in this regard, but when we go to the mechanism, we realize there is some confusion. Then we come to some specific credits, and again, these are some small issues which I thought I'll touch. One is in respect of vehicles. So there has been an amendment, and this amendment came last year with effect from 1/2/2019, where earlier what we were told is that in respect of motor vehicles, you're not entitled to take input tax credit unless and until you're doing specific activities with respect to those motor vehicles. But in respect of goods vehicle, there was never any problem, and it was said that once the goods vehicle has been used for transportation of goods, one would be able to basically take the input tax credit. But there was ambiguity in which the way it was written, and there was some different interpretations which were coming. Once somebody was reading section 17 subsection 5A in respect of blocking of input tax credit of the motor vehicle. Now, with the amendment of law, what basically the subsection says is that in respect of goods vehicle, there is no problem. In fact, now section 5A, 17(5)(a), it only talks about those vehicles of which credit they want to restrict. And they say all passenger vehicles, we want to restrict the credit if they have a sitting capacity less than 13%. So all the passenger vehicles which have a sitting capacity with 13 or more than 30%, now the credit of those passenger vehicles is allowed. So the credit of buses is allowed, but the credit of mini buses are allowed. The buses of small tempo travelers which have a capacity of 13 and more, that is allowed. The credit in relation to services of these items are also allowed. The credit in respect of the change of spare parts of these vehicles is also allowed. There was a problem in this whole context, that is what will happen to the credit of these JCBs and excavators or anything of that regard. Because in the earlier regime, before the amendment, that is before 1/2/2019, the problem was, it says that all the credit of motor vehicles and conveyances, they would be allowed except in these cases. Now, in the exception where they said where the motor vehicle and conveyance has been used for transportation of goods, you are allowed to take the credit. Now the problem is that all these JCBs and excavators, they are conveyances because they are required to be registered under the Motor Vehicles Act. But they are not designed for the purpose of transportation of goods, but in fact they were designed for some another purpose. Basically, they are designed for the purpose of excavation or putting the goods from a specific site or dumping them into some specific place. Though they move on road, and because they move on road and they have tires, that's why they are required to be compulsory registered under the Motor Vehicle Act, and that's why they fall under the definition of motor vehicle or conveyances. Now at least that ambiguity has been solved, so now there is no restriction as such on taking credit of excavators, JCBs, or anything of that sort. The problem would be for all those items which have been purchased before 1/2/2019. Can the credit be taken? My humble understanding is yes. In fact, for period prior to that also, the credit can be taken. Though the issue it is prone to litigation, but at least there was an ambiguity which has basically been rectified. And all of us understand that whenever a law has an ambiguity and a subsequent amendment rectifies it, then we have this judgment of Vatika Township, which says that it can be given a retrospective effect. And because of that, we can take a view by saying that in fact this amendment would have a retrospective effect, and the credit of JCPs and excavators and all that can be taken in this regard. When we come to the credit of insurance, we realize that in case of business, when we look at the expense side, we have various types of insurance. Now in GST, the credit of life insurance and health insurance, it has been specifically blocked. But to understand what is life insurance and health insurance, so generally, typically we face these two types of issues. One is we have these insurance policies which are known as scheme and insurance policies, which are basically for the insurance of the key managerial person, directors, MD, and all those people who are asset to the organization, in which the company makes a substantial investment, and if something happens to their life tomorrow, basically company wants to safeguard itself against the possible financial loss which would happen if in case those people are not there. And that's why they take this scheme and insurance policy, which is nothing else but basically life insurance policy of these scheme and insurance people only. And that is why, because it has been specifically blocked, and scheme and insurance is not something which comes out as a statutory obligation, hence in that regard credit would not be available. However, when you go and look at the workmen compensation insurance policy, it is on a different tangent. And this compensation insurance policy is basically for the employees for whatever injury happens to them as an occupational hazard or while during executing their duty as an employee. And if in case there is any deformity which arises, any injury which happens, or if God forbid any death happens in that case, then whatever compensation, any insurance premium which has been paid and whatever compensation you receive against that, that's typically covered by the workman's compensation insurance policy. Now, because this is neither life insurance and nor health insurance, in fact, that's insurance against the working environment in which people are working and where they have the possible risk. So in this case, credit is available. However, in case of keyman insurance policy, credit would not be available. There is a third type of product which has come in the I would use the word by saying which has come in the circuit by saying this medical insurance, and it's a post-COVID effect where we had when the lockdown was there, we have this National Disaster Management Act which was applicable across India, and under that there was this order which was issued by Ministry of Home Affairs, and basically what this order basically said is all those people now who want to open their industrial establishments, anything, they have to follow a certain SOP. And what basically that SOP said, it has various points. Out of those points, fifth point basically said is that in case of medical insurance is compulsorily required to be done for the workers if in case the factories have to open. Now, all those people who have done this medical insurance, now typically this medical insurance is nothing else but it's a health insurance. And that's how IRDA in fact issued an internal circular to all the insurance companies by saying that how do they have to structure this medical insurance and how this policy has to be basically made available to the various customers. So now typically it's a health insurance. The credit of this otherwise is not allowed, but now because it becomes a mandatory obligation under the National Disaster Management Act, hence because following of this order and because they had to open the offices or the factories, this insurance was being done. Hence, because of this mandatory requirement, the credit of this can be taken. However, some precaution which should be taken by the people in this regard should be that only health insurance of the employee should be done in this regard, but not of the relatives of the employee, not of the family members of the employee, and no recovery as such of the premium amount should be made from the salary or otherwise from the employee, because once that happens, then that issue of making a supply to the employee and all those things would come into picture. But yes, this is an exception to the health insurance, at least this post-COVID, where the credit can be taken in relation to this. Similarly, when you come to the current context, in fact, not only after COVID, but this issue, I believe, would be taken up sooner or later by the department, where under section 17(5), we have this clause G, and the clause G says that a person is not entitled to take basically credit of goods and services which are used for personal consumption. But the problem is the whole law is silent. What is personal consumption? So tomorrow, if let's say I give uniform to my employees, I give laptop to my employees, I give packaged water to my employees, and in fact, in this COVID situation, I give PPE kits to my employees. And all of this is not mandated under any law. I am just giving it out of courtesy, but I'm giving it so that my employees feel motivated, they feel safe, or they are facilitated to work. Can I say it is for personal consumption? Or to what extent the meaning of personal consumption has to be stretched? Or whether human consumption can be treated as a personal consumption, because water will be consumed by the employee. Can I take a plea by saying that if he will not drink water, he will not be able to work? Probably that logic, it may sound absurd, it may sound a very far-fetched logic, but can I take that logic in this regard? Or whether can I take a view by saying personal consumption, I have to read vis-a-vis the registered person, but I have to not read vis-a-vis the person who will be consuming it. In a sense, if let's say company is taking the input tax credit on, let's say, supply of PPE kits. So all the PPE kits which have been purchased by the company and they have been given to the employees while they'll be working, or let's say water or uniform or laptop, whether company is personally consuming it or employee is personally consuming it. And just because employee is personally consuming it, am I covered by G? And in this regard, we have a judgment of Gujarat High Court. Again, it's a judgment in respect of income tax, not in context of excise service tax of GST, but it is on the same analogy, because all of us know under income tax, we have this personal use concept, and all of us have been making disallowances for personal use. Now, the question which was before the Honorable High Court in this case was whether the car which has been given to the director and the MD of the company, and that car has been used by the director or the MD for his personal use also, can it be said that company will not be entitled to have deduction of that expense under income tax because it has been used but for the personal use? And in this case, the High Court rightly said that you have to look personal use vis-a-vis the person who is actually claiming the deduction of the expense, but not the person who is using it. Because company is an artificial person, company cannot have a case where it will do anything which is for the personal use, because company itself is not a natural person. And when you bring that analogy in the context of GST, you realize that at least under this clause G, irrespective of how much an expense looks like for a benefit of a specific human being, if that credit of that expense or inward supply has been taken by a company, by an LLP, by a corporation, by a trust, or anything of that sort, in fact, to that extent, by a partnership firm, to my understanding, there can be any case of reversal of input tax credit. But yes, if the credit has been taken by individual proprietorship firm and it has been consumed by them themselves, then there can be a case where this 17.5G can be invoked. When we come to the concept of immovable property, all of us know that under GST, there is a restriction on taking input tax credit in respect of expenses which have been done for construction of input tax immovable property. And the credit of works contract is only allowed if it is against the outward supply of works contract, or credit is in respect of goods and services only allowed if the building has been constructed and if it is not for own use. Now, for on his own account, basically. Now, this issue basically came up, and all of us know that today all those people who construct malls or buildings for the purpose of giving on rent, for the purpose of warehouse, for the purpose of constructing of hotels, they are not allowed to take the input tax credit because of this clause 17.5C and 17.5D. Now, before going to 17.5D, I think one thing which should be, all of us should be very clear, the way in which it is written is, when you read 17.5C, 17.5C is very crystal clear. It clearly says that in context of works contract services, until unless that works contract service has been used for providing outward as works contract service, we are not entitled to take input tax credit. So at least there is a specific bar on works contract service which all of us have to understand, and up till this law is amended, 17.5C, we cannot basically take credit of works contract if it is not used for providing outward as works contract, that is construction services and that sort. The whole point of discussion is on 17.5D, whether apart from works contract, all goods and services which has been basically received by a registered person for construction of a property which is not on his own account, can he take credit? In this case, all of us know we have this Odisha High Court judgment which says what is construction on own account. And in this case, there was this person, there was this company who was constructing malls to give it on rent. They went to the High Court and they said that is 17.5D on his own account has to be read down, and it is to be read down in a sense, if that building has been constructed for the purpose of giving it on rent, you should be allowed to take credit. Odisha High Court take that view that yes, it should be read down and credit should be given. Now the matter is pending before apex court. The notices have been issued, though it has not been, the stay has not been given to this judgment. Now in this context of the judgment, we would not go into details of it because the matter is already pending before Supreme Court. But the point which comes is what we can do at the ground level today. If tomorrow, let's say there is a favorable judgment comes, because there is a possibility it can go both ways. There can be negative judgment, there can be positive judgment. The judgment of Odisha High Court may be upheld also. So for this, first of all, we have to understand that in the earlier regime of service tax, we had similar, almost similar provision, and we had favorable views. Favorable views were given by Mumbai Tribunal and Ahmedabad Tribunal in similar lines only, where malls were being constructed for the purpose of renting. But more on that, rather lesser on this, but more on the planning side, if we can really go, what basically we can advise the clients is that you take credit today of all other goods and services except works contract, take it in your books of accounts, take it in your GST returns, and reverse it immediately and just write a letter to the department. What is going to happen by that? What the one thing which is going to happen is that because you have taken it and you reversed it, at least the time limit of section 16 subsection 4, because if let's say Supreme Court judgment comes in the year 2020, 21 or 2022, and at that point Supreme Court says that yes, everybody who was constructing mall or for hotel or warehouse for the purpose of giving it on rent or for using it for the purpose of earning revenue, they can take credit. Then in that case the issue will come, but we have lapsed the time limit for 17, 18, 18, 19 and 19, 20. So that judgment is of no use for us. So to avoid that, take credit, reverse it, so that once you reverse that, there cannot be any interest liability. Even if you don't reverse it, but don't use it. So not using it is important. You take it, you don't want to reverse it, but you take it a precaution that you don't use it. There is no provision under section 50 also which says that you will be liable to pay interest, because neither 51 will be applicable in this case and nor 53 would be applicable in this case, because they are on different footing altogether. But what is the flip side to this? Flip side to this is, once you actually take the credit and reverse it, you might reverse that in your books of in your returns, but you have to keep it as a current asset in your balance sheet. Once you do that, you will not be allowed to capitalize that in your building, because if you capitalize that, then you would not be, and if you claim depreciation on it, then we have section 16 subsection 3 which says once you claim depreciation, then you cannot claim input tax credit. So you don't want to fall in that situation where you have done everything properly in your books of account or in your returns, taking and reversing, but you put that in your with your capital asset, and you take benefit of depreciation, and then you realize that suddenly all of this becomes messed up, and that's not the correct way of planning it. So in this way, probably somebody can take a view that how it needs to be planned, and accordingly they can move forward. But a very interesting point which comes from this is input tax credit on plant and machinery. And I think here probably an understanding has to be there that even if a plant and machinery, which ultimately becomes part of an immovable property, if it has the features of plant and machinery, you would be entitled to take credit of it, irrespective it becomes permanent part of a building. The point is, when you read definition of plant and machinery, it is worded in a little different manner, and it is very narrow. And that definition, which is in a narrow sense, it should be very clear with us, because what explanation to section 17.5 says is that the expression plant and machinery means apparatus, equipment and machinery fixed to earth by foundation or structural support that are used for making outward supply of goods or services of both, and includes this. Now, the words which you see in bold that are used for making outward supply of goods and services, friends, if you recollect, when we read section 16 subsection 1, in section 16 subsection 1, this condition was not there. So for general input tax credit, the nexus has to be with business. The nexus is not with the outward supply. But in respect of plant and machinery, the explanation says that there has to be nexus with the outward supplies, and that nexus needs to be proved. Now that the nexus has to be direct, it has to be indirect. For that, the provision is silent. But we have a lot of judgment in the context of excise regime also, where the nexus theory was there, and a lot of high courts have taken a view by saying that there is no requirement to have a direct nexus. Even if we have an indirect nexus, there is no problem, and credit can be taken in that regard. So now when you look at all this, and when you take certain examples, when you talk about a water treatment plant, you talk about a passenger lift, and you talk about a goods lift. No doubt, all three of them, they are by nature plant and machinery. They are affixed to the earth or to the building in such a manner that they permanently become part of that structure. Now, can I take credit of it? And let's say I'm a factory. So can I take credit of water treatment plant? That depends how am I using the water treatment plant. If water treatment plant is used in relation to a manufacturing activity or supply of goods, I don't see any problem. I'll be able to prove the nexus. If I'm using goods lift for movement of my material from one place to another, no problem. I'll be able to take credit. Can I take credit of passenger lift in respect of in respect of the factory which I'm talking about? What is the nexus of passenger lift with the manufacturing or supplying of goods which I'm making? Can I take a view by saying it will help in moving of the various executive staff and the worker class from one floor to another floor, or one building to another building, and so that the work will be facilitated and they will work, and then I'll be able to supply goods? Again, it is very far-fetched, though it looks it is litigation prone. You would find both favorable and against judgment in this regard. So maybe in respect of passenger lift, we might have a difficulty, but yeah, in respect of goods lift, water treatment plant, there would not be any difficulty, and we can go ahead accordingly. When we talk about employer related expenses, now it's a very funny provision. Why I say funny? Because so what the general rule is that we cannot have input tax credit of food items and beverages item until unless it has been mandated by a law, by a law, that we have to give it to the employees under a certain law, or it is part of my outward supply. So I'm not on that point of whether it is part of outward supplies or not, But let's say all of us understand in respect of factories and everything, we have this Factories Act under section 46. There is a mandatory requirement that every factory which is covered by this Factories Act, they need to have a canteen or at least a canteen facility, which would be used by the employees for the purpose of their related activities of food and everything. Now, let's say a factory is running a canteen and it has appointed a contractor who would basically bring food and do all those things, and that food is basically being given to the employees for the purpose of consumption during the course of doing their function. Now, whether company can take credit of this, the answer is definitely yes now after amendment, because it is a mandatory thing against that, because they would be able to take credit. Now, the point is, and where the whole issue comes up, if let's say tomorrow company provides this food at a subsidized cost to its employees, and let's say they charge 6 rupees, 7 rupees, 10 rupees on the employees, and let's say the cost of food is 50 rupees, and they are ready to bear the 40 rupees out of it, and 10 rupees they are recovering it from the employees. Now, the question will come whether it becomes a supply to the employees, because it is a supply by employer to employee and they are related parties. You might have a different view on that. But the view you will take, either of the two, whether it will be leviable to tax or not leviable to tax, will actually decide your input tax credit. And that's the funny part of this. Why am I saying this? So let's say you take a view that yes, it will be leviable to GST, and the company would be required to pay GST on, let's say, 50 rupees or 10 rupees, whatever is the case. The problem is the law says that once you are required to pay tax on these outward supplies or outdoor catering or food facility, the rate of tax is 5%. And the rate of tax is 5% compulsorily, with a condition that you will not take input tax credit. So once you take a conservative view that you want to pay tax on the outward supplies, you will not end up paying tax on the outward at 5%, but you will not be entitled to take input tax credit of the tax which has been charged by the contract or by the canteen supplier. If you take an aggressive view by saying, no, I don't want to pay tax on the outward supplies because it is not as outward supply which I made to the employees, then not only you will not pay tax on the outward supplies, you will be entitled to take credit of 5%, because now you are not bound by the 5% outward condition. And in fact, 17.5 allows you to take that credit. So if you want to pay tax, you are actually ending up paying 10% tax. If you don't want to pay tax, you are actually ending up having a 5% additional benefit. And on that basis, basically one would take a view that what view they want to follow. Though in the earlier regime, again, we have an Andhra Pradesh High Court judgment in respect of service tax, which says that it is not a service which is provided by the employer to the employee, the subsidized food, because it is part of the package of the workers which is being there. But mind you, friends, and a precaution that this judgment, basically, though it had this remark, but the judgment, though it was a favorable judgment, but it was majorly on the premise because the company was discharging VAT on the food component. So they said, once they're discharging the VAT component, we don't want to levy any service tax in this regard. So this judgment is there. It looks a favorable judgment. It has a favorable remark, but to what extent you are going to use it, that has to be seen in that other line. When you come to CSR expenditure, whether you are allowed to take input tax credit or not, I'm sure all of us have different views. The only point of contention is that the CSR policy clearly says you cannot incur expenditures that are related to the business, and the input tax credit provisions are altogether contradictory, which says you can only take input tax credit in respect of those supplies which are in course and furtherance of the business. So at one hand, you have ITC, which says you can take credit only in course and furtherance of business. On the other hand, you have CSR, where CSR says that expenditure cannot be in course and furtherance of the business. You have one more point in this, which is very important. Under income tax, there is a specific disallowance under section 37 for not allowing the benefit of expenditure which have been made for CSR. Now, in GST, there is no specific disallowance, and I think all of us should be aware of this, that in respect of CSR, there is no specific disallowance. Now, once you have a specific disallowance in income tax, that means at least they treat it as a business expense. That's why they give it as a disallowance. That's one of the theories which comes out from this. Now, whether this, though the expenditure on CSR, they cannot be on business activities, whether they are in course and furtherance of the business, because if these activities are in course and furtherance of the business, then we are basically covered by 16.1. We are entitled for credit, and because 17.5 has no restriction, and hence in that sense we would be allowed to take credit. So in this regard, we have an old judgment. It's a 1953 judgment, but it is a very useful judgment. It's a judgment, Supreme Court judgment only, in Shangmuda Vilas cashew nut factory case. What this judgment basically did is it tried to interpret what is the meaning of in course of, and it was interpreted in the context of Article 286 1B of the Constitution of India, whether it was talking about import in course of or export in course of. So there, the point was that in course of basically doesn't talk about a specific point of time, but it talks about some related connection also. So if you are able to establish some related connection, the in course of basically would tantamount to that connection which you have. And in this background, when we go back and see CSR expenses are connected with my business only, because if I did not have business, I would not have done the CSR expenses. Though those expenses cannot be related to my business activities, but those expenses have connection with the business. Because they have connection with the business, I can take a view by saying it is in course and furtherance of a business, and I would be eligible for input tax credit. In this regard, again, we have a favorable judgment from Mumbai Tribunal. It was in context of service tax. Very recent judgment, SL Pro Pack. What this judgment basically says is, and if you read the underlying part, it says CSR can be considered as input service and be included with the definition of activities relating to business. And in doing so, a company's image before corporate world is enhanced so as to increase its credit rating as found from the handbook of CSR activities discussed above. Hence, the answer is affirmative and they are entitled for the credit. So I think with this, and in fact, this judgment talk about a lot of other things also, that how by doing CSR activities, company can easily procure raw material. They are easily procure the human resource because the brand image improves and other things. So in that regard, I think it is safe to take a view that it has connection with the business and the credit of CSR expenses would be available. So no doubt again, a litigation in this regard would come. Now, this is a very interesting issue again, and probably this is something which I was able to understand, that there is some drafting lacuna which is there in the rules, or even if it is not a drafting lacuna, when you compare it with the earlier rules which were there in excise and service tax, and when you try to find out analogy, you realize that there is some difference which is there. So all of us know we have section 17.2, 17.3, 17.4. Basically what 17.2 and 17.3 says is that whatever input tax credit which we are taking, it should, our claim is basically restricted to the extent this credit is attributable to the taxable supplies, and to the extent the credit is attributable to the exempt supplies, then in that case we are not entitled to basically retain that input tax credit, and that should be reversed. Now, before I go to that rules issue which I just discussed, before that I want to bring out this issue which has recently cropped up in the course of processing of refund claims, and the department has taken a view on this. So what is this issue? So all of us know that exporter of goods and exporter of services, they are entitled for MEIS and ACIS licenses. Typically, these MEIS and ACIS licenses are the incentives which have been given by the Ministry of Commerce, because these people are bringing in foreign currencies, or say we are giving you a license. This license can be used by you wherever you want to make an import, so you don't have to pay the import duty to the extent what is the value of this license, and this license is calculated on the basis of whatever exports you are doing. Against that they have a certain percentage. If somebody doesn't want to use this license against the import, if they don't have the import, or they don't want to use it at all, then they go and sell it in the market. So let's say the license value is 100 rupees, then they can go and sell it in the market in 90 rupees, so that they are able to earn 90 rupees, and the person who is buying it is able to save the duty up to extent of 10 rupees in that regard. Now, what is the issue coming is that when you sell these MEIS licenses are treated as goods. And there is an old legacy behind this, that because they are tradable, they have transferable value, they are property in nature, so they are goods. When you go to rate notification of goods, you realize that there is an exemption given in this regard, and that exemption which is given is that it says the rate of tax applicable in this case is 0, and hence it becomes an exempt supply. Now the issue which is cropping up is, let's say I'm making an export of 100 crore rupees, and against that I have this license which is of 10 crore rupees. Department is of the view by saying that, see, whatever tax you have paid on the inward supplies, and you have used that for making the exports, so you have not in fact only made the exports, but you have actually sold the license also. Because you made exports, And against that, you made all these expenses. So with these expenses, you only did not have benefit of export of goods, but you also had the benefit of selling of this MEIS license, and hence your all of your input tax credit becomes a common input tax credit, and it should be reversed to the extent of 10%, because 10% of the supplies are exempt supplies. Now, the concept which probably the department has missed out in this case is, when you read 17.2, it says all your credit which is attributable to the taxable supplies, to that extent you can take, and it is attributable to exempt supplies, you are required to reverse. The word used is attribution, and how will you identify the attribution? For this, the concept of this license needs to be understood is that when somebody export goods, they do not sell the license, but actually they get a right to have the license. So it is the inception of the license takes place when somebody actually sells the goods. Once the goods are sold, they have the entitled for the license. They can do two things with the license. Either they can go and use it against the import, or they can go and sell it in the market. So whatever activity of selling takes place, that's a subsequent activity. Now, against that activity, my credit of raw material against which I have bought the finished goods, and I have manufactured the finished goods which I have exported, has no nexus at all. And that is why my whole credit cannot be taken as a common credit for the purpose of Rule 42. Maximum the credit which can be treated as a common credit is credit of telephone, credit of maybe maintenance charges, credit of internet, credit of commission which I have paid for the sale of this license, but nothing else. And that is why all the notices issued, all the paras made in this regard, they probably, to my understanding, are not correct. Now coming to the second issue in this regard, let's say I am required to reverse the credit, and now I take another example. Let's say I'm genuinely making a supply of exempted and taxable goods. I have a common input tax credit. How am I going to reverse that? So all of us know we have Rule 42, which is given under CGST and SGST rules. It says is that there is a specific formula given. We have T1, T2, T3, T4. I would not go into details of it, but the concept behind that is, you take the credit of a particular month, you take the exempted turnover, you divide it by total turnover, whatever value comes, you just reverse that credit. They say you do it on monthly basis, and then at the end of the year, before September, you do it again. The point is, it has to be understood, how am I supposed to do it again? Am I supposed to look at whole year at a time, or am I supposed to actually not look at whole year at a time, but the aggregation of whatever reversal I've done on monthly basis? And I think here probably there is a drafting difference in Rule 42 when you compare with the same concept which was there in Senvat Credit Rules, Rule 6. So Senvat Credit Rule 6 was exactly worded in the same manner. It was on same concept. It also asked for monthly reversal, and then it asked for the yearly reversal. But the difference was that when it asked for the yearly reversal, and what you see on the right side of your screen, Rule 6, the 6AC, what it basically said is that when you are going to do it on annual basis, you are going to do it in following manner. And then there was a manner which was given, in which manner they said the credit will be on annual basis, turnover total will be on annual basis, and exempt turnover will be on annual basis. When you compare with existing Rule 42, Rule 42 says you do it on monthly basis, then you do it on annual basis. When you do it on annual basis, it says in the last, which is very important, in the manner specified in the said sub-rule. In a sense, it says we are not going to tell you any new manner. You do it in the same manner you do it earlier, but you do it in annual basis. So now when you go and read the manner, so in front of you, that is a manner which is given there. You realize that this manner says that it has to be done for a tax period. It never says it has to be done for the annual whole period. It says it has to be done for a tax period. When you read definition of tax period says the period for which the return is required to be furnished. And all of us know that return is required to be furnished on monthly basis. Return is not required to be furnished on yearly basis. Hence, basically the point which I'm trying to bring here is that whenever we do a Rule 42 reversal, it is only required to be done on the basis of whatever credit I had on that month, in that month, and what is the amount of reversal I was required to do on the basis of turnover of that particular month only. I don't have to analyze my credit. I don't have to analyze my turnover of total turnover of the exempted turnover. And when you apply this concept, you would realize your reversal will always be lesser as compared to when you try to do it on an annualized basis. So rule 42, it never gives us new formula, and hence we are not required to go it on an annualized basis. I will take 2 or 3 of the smaller issues now, and then probably we'll open up for question answer session. Though by the heading, I'm sure you would have understood this is not a smaller issue, that is ISD versus cross charge. And there are different views to this in respect of credit and everything. But I think typically, if you want to understand what is this concept, so let's say there is this company which has a head office in Mumbai, and it has two branch offices or two factories, basically one factory in Calcutta and one factory in Noida. And let's say they have a supplier who is sitting in Jaipur. So what head office typically does is that it executes a contract, a rate contract or a PO with the supplier A, and against that they say that you make directly supplies to my factories in Kolkata and Noida. And you make invoices to them. Those factories will take input tax credit of your invoice or anything of that sort. But the payments will basically be made from head office only, and necessary accounting entries in this regard will be routed through between the branches and the head office. So payment and rate finalization will be centralized, but the dispatches will be to the specific locations. Now, in this whole process, we realize that there are some credits which are sitting at Mumbai. There are a lot of credits which are there in Kolkata and in Noida. And we know that there is this entry 2 to the schedule 1, which says that there has to be concept of cross charge, and there is some supply of service happening from head office to branches and all those things. I will not go into that concept because again, that's not the topic today, but I will be only restricted myself to the input tax credit. And when I talk about the credit of the Mumbai office, in this case, I realize that there are two types of credit. One is the external credit, one is the internal credit. What is external internal credit? So if I may in fact rephrase it, it is not external internal credit, but external expenses and internal expenses. External expenses are those expenses which are done by the Bombay branch head office through some another outside vendor, maybe let's say for auditing purposes, legal fees, telephone and all those things. And internal is the manpower cost. Now tomorrow, let's say I want to say that I want to cross charge, I have to find the valuation and all those things. I think before that, this concept of input service distributor should be understood very clearly. What is this concept? Though input service distributor as a concept, it is not a mandatory thing to be followed. It is always discretionary, but it is a facilitating concept. And once you do that, they are mutually exclusive to each other, and they are both based on different concept altogether. That is schedule 1 deemed supplies, to which we loosely call as cross charge. There is nothing which is called as cross charge in the law, but we still use the law. Input service distributor is a concept which says I have received some invoices of input services, but the benefit of it actually belongs to some another distinct person of mine, and I want to transfer it to that, and I will follow the procedure of ISD which is given there. So that's the concept of ISD. Deemed supplies is basically a liability which says because the head office has done something, and that something looks like a service, and because we don't have a value of that, but still it is some service, and hence it becomes a supply of service by head office to the branches. I'm sure while I was speaking, you would have realized that I've used word something 3 or 4 times, but unfortunately, it is on that premise only this concept of whole cross charge is based, that there is something which has happened from the head office. What is that something? Nobody knows clearly, but something has some ingredient in it, and let's on that some try to go and find out in this regard. So first of all, can HO take the credit of all the expenses? Yes, it can do either through ISD or through another regime, another person, or through cross charge, for a simple reason that in 16.1, when we talked in the starting, it uses the word his business. So in fact, the business of the branches also belongs to the business of the head office, and there is no problem in taking the credit. They should have received goods and services. They have received goods and services, because for goods, they would have actually received them. In respect of services, the recipient of service is the person who is liable to make the payment. And once they are liable to make the payment, practically they become the recipient of the service. Then you come to the concept of realizing whether a cross charge in this case would happen or not. That basically would be depending upon a point where one has to understand when you go to schedule 1 entry 2. Schedule 1 starts with supply without consideration. So it starts with the word supply. It starts with the word activities, but when you go to entry 2, it says a supply of goods or services or something. So the point is, whatever functions have been done by the head office, whether they are functions, they are activities or supply, because entry 2 uses the word supply, and till the time we cannot identify the concept of supply clearly, probably in that case the concept of cross charge would not come into picture. And in this whole point, I want to bring a judgment. It's a judgment of the Canadian court. This Canadian court judgment is an old 2003 judgment. Just for the reference, Canadian GST is most akin to the Indian GST, because there also they have a dual GST structure, just like we have this dual GST structure. The issue before the Canadian court in this case was the exact this issue, that the person who is carrying a business to a permanent establishment of the person in Canada through some another permanent establishment outside Canada, and there is some activity which is happening between these two PEs, and there is a valuation mechanism given that if in case there is some supply happening between these two PEs, that how that valuation has to be done. So the GST officer said that, see boss, cost allocation becomes a supply. So whenever there is a cost allocation happening between a head office to a branch, that becomes a supply, and because we have a valuation mechanism given, we will treat it as a cross charge. What the court said in this case is, they say that by fiction, basically it has been said that once there is a rendering of a service, even if without consideration, you will charge GST. But they say just because there is a valuation mechanism, can you also say that by fiction some supply has happened? The point should be that first you identify the supply. Once you have identified the supply of what has happened, then only you go to the valuation. Just because there is a cost allocation which has happened, that will basically not become a supply in itself. And hence, in that point, I think this logic has to be brought into India, maybe at some point of time, and probably with the passage of time, the maturity would develop. So at least in all these cases, there is no requirement to basically do a cross chart. I'll take this very interesting issue, but in respect of distinct person, where probably lot of us to liquidate the credit, we do some planning. And again, as a chartered accountant, that's what we're expected to do, that we should be able to plan not only the taxation, but also to look at the financial aspect of it. So let's say I have a factory A and I have a factory B. Again, factory A in Rajasthan, factory B in Chennai. Factory A in Rajasthan has a lot of credits, and factory B in Chennai has goods. Let's say there is a customer of Delhi who is sitting in Delhi, and he says to factory in Chennai that they want some goods. Now, what factory A in Chennai does is that they bill to the factory which is there in Jaipur, let's say at 100 rupees, and then factory in Jaipur basically bills to the customer at 200 rupees. So what is the whole purpose of this? The whole purpose of doing this is that on 100 rupees, let's say 10 rupees GST is there. So factory in Jaipur, they will take credit of 10 rupees. But when they will bill customer at 200 rupees and let's say GST 20 rupees, so they will be able to liquidate their credit of 10 rupees charged by the Chennai plus additional credit of 10 rupees which they have here. And typically we say by bill to ship to model between distinct persons, we would be able to do this, and that's how we would be able to liquidate the credit, because that's the problem across India today, where my one factory has a lot of credit and my other factory does not have the credit. How do we do this? How does the valuation is changed? The valuation is changed on a simple concept as to say by, we have this rule 28 for valuation, and rule 28 proviso clearly says, if you read the last proviso in the slide, it says where the recipient is eligible for full input tax credit, the value declared in the invoice shall be deemed to be the open market value of goods and services. And we say clearly the factory in Jaipur is eligible for full input tax credit of this invoice, and hence there is no problem, and then we can do with this valuation. The point is, we have to understand in case of a bill to ship to transaction, where one party is the two parties are distinct person, and the receiver of goods is the last person sitting in another state. Who is the recipient in this case? That has to be understood. And when you go and read the definition of recipient, you realize that when there is no consideration payable under GST, the definition of recipient under 293 says the recipient is the person who is actually receiving the goods. So recipient in this case, when the invoice is made by Chennai upon Jaipur, because Jaipur will never touch the goods, because goods will directly go from Chennai to Delhi. Here in this case, a view can be taken by the department, which according to me may be the correct view, that recipient will not be Jaipur, and because recipient will not be Jaipur, it is not the case where they are eligible for full input tax credit, or this whole proviso would fail. So my understanding would be that bill to ship to transactions for the purpose of differential valuation and liquidating of ITC, Maybe in case of distinct person, they should not be applied. I'll take last two issues. One is this issue which comes up before us a lot of times by saying, I have not made payment to my supplier within 6 months. Am I required to reverse the credit? Because there is this section which says that proviso, in fact, to section 16, 2, which says that once there is a failure to make payment to the supplier, I am required to reverse the credit. I will not go on that point by saying that whether there is a failure to reverse the failure to make payment to the vendor or not, but I'll go on a different point of view, that point of view which is less litigative, which is clearly evident, which has an evidential value, and probably that in fact safeguards us to the maximum extent. That is, let's say I have made this breach, I have not made payment within 180 days. Now what? Now I have to reverse it. I said, okay, I'm ready to reverse it. How should I do that? So they say there is rule 37. You go and follow rule 37. Rule 37 says that you have to reverse it and you have to pay interest also. I said, okay, I'm ready to do that. Where should I show the reversal? The rule 37 still says that you have to show the reversal in GSTR 2. Probably it looks like they wanted to write 2 and 3B, but 2 should be read as 3B. And there the whole difference is. In the whole rules, wherever government wanted to make a change and wherever they wanted to introduce 3B, they have introduced 3B. Rule 36, 2 and Rule 37. These are two rules where at specific instances, government has still retained GSTR 2. So my whole point is, I am ready to reverse it, but the point is your GSTR 2 is postponed. So I will also do the reversal once GSTR 2 will be live. If GSTR 2 comes, because you have never said GSTR 2 will not come, you have still maintained that GSTR 2 is postponed. Whenever GSTR 2 will come, I will do the reversal. I will pay the interest. Please don't tell me today how I have to do it today, because there is no mechanism available. Can I take this plea? I can take this plea. Why? Because if tomorrow government would not have notified form GSTR 9, would I have been able to file annual return? The answer is no. So even if they would have written in the rules, even if they would have written in the section, if the form 9 was not there, I would not have been able to file my annual return. Similarly, I want to do the reversal, but it says it has to be part of GSTR 2. Once you bring 2, I will do my reversal in that case. This judgment, it is a very important judgment. I'm sure all of you have gone through this judgment. It's a Delhi High Court judgment. We should use it. Why we should use it? Because majority of us invariably have made errors in our GSTR 3B. We have not claimed credits. We have skipped claiming those credits, and there can be various reasons to that. So what are the brief facts? Brief facts is that this company Bharti Airtel, during the period of July 17 to September 17, they were hoping that GSTR 2 will come, and they had faith that GSTR 2 will come, and once 2 will come, there will be matching process. Their implementation would have been probably in a way where the implementation has been done. They said, once we will see in 2 way, we will match and then we will take credit. Because 2 only came for a short period of July 17, it never came after that. The whole understanding of Bharti went for a toss, and then they took a conscious decision by saying, okay, we will claim ITC on estimate basis, and sometime 2 will come and then we will rectify all this. But 2 never came. And then this circular came in December 2017, 26/26/26, which said, okay, if you have made error, you wanted to claim credit, you did not claim, you did all these things, no problem, you do that in the subsequent return. Subject to you do it before September of the next year. So circular says it can be done in the subsequent returns. In the meantime, Bharti went to the High Court and Bharti said, it's good that you are saying we can do the correction. But the problem is your circular says that correction can be done only in the subsequent returns. Now, what will happen for that, where we have paid tax in cash between the period of July to September 17, because we only took credit on the basis of estimate, because there was no 2A available, there was no 2, we were not able to match, we wanted to follow law, and that's why we did not take the credit. And now when you ask us to take credit in the subsequent months, I don't have that much amount of tax liability. And then whatever tax I paid for the previous period, I might be liable to pay interest on that. Plus, why should I pay interest when your provision under section 37, 38, 39 allows me to rectify my return, and it never says that rectification will always be prospective. Rectification says that I can do a rectification for the previous period also. So please allow me to rectify this. If they went to the High Court basically understood the whole context, and they said that 37, 38, 39, which gives the right of rectification, is not procedural. It is substantive in nature. And once it is substantive in nature, a circular cannot say that you will make all your rectification in the subsequent returns. What they said is that benefit to the Bharati should be given. They should be allowed to rectify their previous returns. How, that nobody knows, but that's the High Court has said. You should be required to rectify it. And because of that, if any tax has been paid in cash unnecessarily, which was not required to be paid, then in that case, you go and take necessary benefit of this. So tomorrow, if any notice comes in the light of circular number 26, which says because you have made rectification in the subsequent period, pay interest, or you are not entitled for credit and all these things, probably this judgment of Delhi High Court would be definitely helpful. I think I will be overshooting my time if I take this, but yeah, I would be tempted to take this 16.4 issue because there are a lot of issues which are cropping up in respect of this section 16 subsection 4. What is the issue in this section 16 subsection 4? So I'm sure some of you must have received a notice like this from the department, where department has said that you have filed your GST returns, very good, but the problem is that your GST return for 17-18, the last date to claim credit was October 18. In some cases, it got extended to 31st March 2018. But what you have done is that your returns for July 17 to March, sorry, the date was extended to March 19. But what you have done is that you have filed your returns for July 17 to March 18 after 31st of March 2019. And in fact, your returns for 18-19 also you have filed after 25th of October 2019. So you have breached the provision of section 16 subsection 4, because section 16 subsection 4 basically says that a registered person is not entitled to take credit if in case the credit is taken after the due date of filing of return for the month of September subsequent to the financial year or annual return, whichever is earlier. And that's what this section 16.4 says. So because you have filed returns after the month of September 2018 and September 2019, so we will not allow you credit. So please reverse all the credit. And in fact, the notices have been received by the people who are having turnover of, let's say, only 1 crore rupees, and they have a margin of not more than 5 lakh rupees. But because their credit amount is such huge that they have received notices for input tax credit reversal of 30 lakh rupees. So in fact, it is the ITC reversal, which is 5 times the amount of profit they might have earned while doing that transaction. Now, whether these notices are valid, again, I would not touch upon what is the constitutionality, credit is my vested right or not, but I will take cue from what is written in the law. So what is written in the law is, when you read section 16 subsection 4, and I'm sure you might be able to see that in your screen, it uses the word, which is a very interesting word. It says registered person shall not be entitled to take input tax credit. So it uses the word, you will not be entitled to take input tax credit. What is taking of input tax credit? It is not defined anywhere in the law. So then you have to look for other references, that what is the manner of taking of input tax credit. Now let's come back to this, these 4 conditions 16.2. If it is understood that credit is taken through returns, then nobody is actually satisfies the condition of section 16 subsection 2, and technically all of us should be slapped with a show cause notice. Why am I saying this? I am saying this because when you look at 16 subsection 2, what it says is you should have an invoice. Okay, I have an invoice. You should have received goods and services. I have received goods and services. Tax should have been paid. Tax should have been paid. And you have furnished return under 39. Now, when it says you have furnished return under 39, does that mean that I am taking input tax credit in the return, or actually I am recording that in my books of accounts first and then only I'm doing that in my return? Because if taking of input tax credit is the first criteria, that's the first thing, then the return has to be the subsequent thing. It cannot be that I file the return first and take input tax credit. It cannot be that it has to be the parallel things which go on, because practically it is not possible. So we realize some conditions are the precedential conditions, some conditions are the subsequent conditions. So taking of credit does not happen through return. And when you try to find reference from law to this, you realize that in law, availment of credit and taking of credit, they had been used at different instances for different purposes. I remember there is a circular number 37 in context of refund, and in the refund they say that credit is availed through GSTR 3B. They clearly use the word availed through GSTR 3B. In fact, when you look at show cause notices issued in 73-74, it never says you have wrongly taken input tax credit. It says you have wrongly availed input tax credit. In fact, when you look at section 18, which talks about reversal of input tax credit, it always says that whenever somebody has availed credit and he is opting out of a registration, he has to reverse the credit. But when it talks about taking credit, it says when somebody was not registered and is taking a registration, then he can take input tax credit. So maybe availment is part of the process, but first you take credit in the books of accounts, then you avail it in the returns, and then maybe you utilize it or you reverse it. Section 16(4) is a restriction on taking the input tax credit. It is not a restriction on availment of input tax credit. Availment happens through returns. I might file my returns at a later date, but that's not given in 16(4). If I have shown the credit in my books of accounts before the end of September from the end of the financial year, I have followed the conditions of section 16 subsection 4, and there is no problem. I am entitled to take the credit, and all the notices which have been issued with the word using you have wrongly availed, basically it is not a question of availment at all. It is a question of wrongly taking of credit, and taking happens to books of accounts but not to the returns. And in fact, you will find a lot of judgments of the older regime, service tax excise, where they had excise records where in which we were punching the credits RG1, RG23C and all these things, and then we were filing in return. So where somebody could not show that in the return, somebody filed a late return, there are a lot of tribunal judgment which say that punching of figure in the return is only indicative, it is only informative, but by that no right basically arises. And hence in that regard, basically these notices in my understanding are not correct if the credit has been properly recorded in the books of accounts before the end of the September. So before I end my monologue, and if in case we have any questions to take, before I end, I always end with this question, that up till now for last two hours, if you thought that I was making some sense, I was trying to interpret some provisions, then probably for the last time, I would ask you to interpret what do you see on your screens. And probably there will be three set of people. Somebody would say it looks like B, somebody would say it looks like 13, and somebody would say no, it is nothing, it is just pure scribbling, but it has no sense. Probably for the third set of people, I would not be able to answer it. But yeah, for all those who think that yes, it makes some sense, maybe B or 13, but that is not clear. But if you think this is B and I write it like this, so then probably your answer will change and you will say no, it is more of 12, 13, 14, it is not definitely B. But if you were of the understanding that it looks like 13, and now I write it like this, again your answer would change and you would say no, it looks like ABC only, and you wanted to write B, but you did not want to write 13. The point is you are interpreting a standing line and a curve, right? Either B or 13. And your answer change depending upon the context. In a context, in a sense, what is written before this letter and what is written after this letter. And I think the whole context of GST, the interpretation at least in the GST in respect of input tax credit would depend on the context. In what context we are looking at the provisions. If you are looking at from the context of our side, probably that context has to be clearly demonstrated. If you are able to demonstrate our context, probably our interpretation fits in there. But if you're not able to demonstrate our context, or our context is basically not matching with the interpretation we're trying to fit in, probably in that case, we might not be able to put our point clearly. With this, I would like to thank the association for giving me this opportunity. Thank you all the members for listening for 2 hours. I know it is very difficult to stare at the screen and listen to any speaker for 2 hours, but I hope it was of some use. If there are any questions, I'll be very happy to take the questions. Thank you so much, all of you.
Thank you very much, Speaker Sir. It was really a delight watching you. It was as if you were presenting your case before the tribunal. The arguments were so forceful that the member would always come back and say, yes, your appeal is allowed. So it was such a very wonderful presentation from your end, covering all the aspects. Thank you very much for your valuable time, sir. Let us take up some questions now.
Yes.
A question from CA Ronak Singhi. What about two-wheeler vehicle used for door delivering of goods? Can we take ITC on the same?
Very difficult, sir, because what now the language is, if the passenger has been designed to carry passenger, the vehicle has been designed to carry the passenger, then it can be used only for the specified purposes. So if it is designed to carry passengers, unfortunately, even if it is used for carrying the goods, I don't see that credit would be available in that respect, sir.
Yes, Ji, can you come back on the screen? We want to see you.
Acha, yes, yes, sir.
Yes, sir. Yes, sir. Yes, sir. In fact, before Bharat proceeds with the next question, in my introductory remark, I said that whether the ITC is seamless or not, I do not know. But your flow was seamless. The whole speech was so seamless without interruption. And God's grace, I appreciate your lung power also. Yes, Bharatji.
Yes, are you able to hear us?
Yes, sir. Sorry.
Yeah. So
Yes.
next question is bifurcation of ITC in books of accounts necessary as per GST? If we include GST part in expenses in the books of accounts, can we claim the credit?
Yeah. If you, even if they're part of the expenses, you can claim the credit. The whole point basically what it tries to basically say is that they should be recorded somewhere in the records, and you should be able to prove the nexus in a sense to say you are saying it is used in for the purpose of manufacture. So you say you have used in the manufacture, good, show it. If it is not used in manufacture, no problem. Whether it has been used for the purpose of business, still take the credit. But you cannot take a view by saying I have used it for the purpose of manufacture, but I don't have a details of it. That is not possible.
Yeah. Next question, sir. Traded goods input taken and given sample by dealer, then whether reversal will apply.
This case is a problem. If you are traded goods, you are giving it as a sample, then you would be required to make the reversal, because it is a case which is covered clearly by 17.5H. Goods in respect of which credit has been taken and disposed of by way of samples.
Next question is, I am into food delivery app based business. Can I claim ITC on the two-wheelers?
Yeah, same. I think I already answered this. The way it is worded now, I see a problem in it. In my view, till the time it is written like this, we would not be eligible for the credits.
Next question, sir. What is the difference between ITC taken and ITC availed?
So I was trying to explain so that though when you try to read from the law, it looks like these words have been juggled at various places, and at some places, in fact, there has been a cross reference to this. But the way in which the scheme is there, the way in which your record rules are there. For example, what they try to say in records is you have to maintain three things: input tax credit claim, and input tax credit utilized in that regard. Now the availment, they clearly say through a circular, in fact through a press release also of October 2018, that availment of credit happens through returns. So at least on availment, there is no doubt that you avail a credit only when you file your return and becomes part of your electronic credit ledger. The only point is, when do you take the credit? Now for taking of credit, you see that a different references has been given. Whenever government has wanted to, for the first time wanted to give any benefit, they have used the word taken the credit. So you see 16.1, you see 16.2, you see 16.4, they use the word taken the credit. Whenever wanted to recover any wrong credit or credit which the benefit of which already has been taken, they use the word availed. You see section 1773, you see section 74. In fact, you see section 18. There you will see a clear contradiction. Wherever government wanted to recover any credit taken already, they said you have availed the credit, now reverse it in this manner. Wherever government wanted to first time give any benefit, they say, okay, now you can take the credit like this. So I see the chain happens in a way. Whatever you do in your records, GST records or books of accounts, that's claiming or taking of credit. From that, when you transfer it through your returns to electronic credit ledger, it becomes an availed credit. When that credit is availed, then only you can utilize it. That's the process which needs to be followed.
Next, our member, Mr. Ronak Singhi, would like to ask a query, sir.
Yes, sir.
Hello.
Ronak, you can come.
Yeah, sir, I have a question here. Can you hear me?
Yes, sir, we can.
Yeah. So, sir, now there's a trading organization. Okay. Now they basically, due to some reason, they are closing down the business. Okay. They have a stock. Okay. Ideally, if I name it, if I name it the stock which is there in their books, if I name it as stock write-off, then I have to reverse the ITC and I have to pay GST on that. Okay,
Yeah.
I agree with that point. Now, if I scrap it, basically, there is no restrictions on writing off, reversing the import tax credit, right? Is that fine with my view?
You're talking about a traded goods, sir.
Yeah, yes, traded goods.
So you are saying you are writing them off.
No, no. See, basically, the client
You are scrapping
calls,
them.
which it depends on the nomenclature which I use it. Now, for
But
example,
I got your
2005.
question. Yeah, I got
Yeah,
it. But there is a problem. You might not be covered in 17.5H by the terminology. Okay, that is okay. But you have a problem in Schedule 1, Entry 1, which is permanent transfer or disposal of business asset. Now, disposal can happen by way of
sir.
scrapping it.
That point it says without consideration. The headline says in your slide 15, if you say without consideration,
Correct. So it is not without consideration.
it is with consideration, because scrapping it out, once I sell it for scrap, I'll get it at a
Then
nominal
there is
value.
no problem. Then there is no problem. So, okay, now two things. Once you say that I'm scrapping it with consideration, then you are covered by section 15 that you have to prove it's a transaction value. For transaction value, it has to be price actually paid or payable, party should be unrelated. If you are able to prove that my scrap, I have not received any other incentive through any other way, or there is no circumstantial evidence which proves so, you are absolutely right by scrapping it at whatever value. You may call it a nominal value. I might call it actually the transaction value, and there cannot be any further liability to pay any GST. But if it is otherwise possible to prove through evidences that there might have been some incentive coming in non-monetary consideration or otherwise, by scrapping it, and then probably the valuation provisions would come. So I would say you are correct till the time you say this, that's the only price of the scrap. Till that time, there is no problem. You have to only discharge GST to that extent.
Okay. Thank you, sir. Thank you.
Welcome, sir.
Next question, sir. A movie production company provide food to all crew members at shooting location. Whether ITC can be claimed?
No, no. Why? Because first, it is not mandatory by law. I don't know if it has been mandated somewhere. To my limited understanding, I don't see any law which mandates this. Second, because this is not part of their outward supply. I mean, this food and everything which has been given to the crew, because it is not part of the outward supply, that a billing which they are going to do for this movie production. Hence, it is restricted in 17.5D. They would not be eligible to take credit.
Whether new sub rule 4 of rule 36 will be holding its ground in court of law?
Yeah. So as a chartered accountant, if you ask me, sir, I would, I mean, because I don't want to go to the High Court, frankly speaking, I would say I would try to follow it to the maximum I can. But yes, I can definitely take a view that they cannot ask me to do it on monthly basis. If I do it even on yearly basis, that would be absolutely all right. If you really take a correct legal view from this perspective, on all possible fronts, it is not valid at all for a lot of reasons. All of us know there is this proposed 43A section which is there. Second, in fact, section 42, through which we actually take the self-assessed credit in our GSTR 3B, it nowhere talks about this. In fact, rule 36 again, which talks under which this sub rule 4 is there, it talks about conditions for claiming credit and documents thereof. So again, where can condition of claiming credit can apply to my self-assessed credit or not? That is also a question. So legally speaking, no. Again, as a chartered accountant, I will say you can take a view by doing it on September basis also. But otherwise, also I think that's a good discipline to develop if in case we are able to to identify it. But I think one easy view can be taken in this regard. Obviously, it might have a financial consequence. That is, whatever comes in your GSTR 2A in September 2000, let's say 20, if I'm talking about, whatever is there in your GSTR 2A, take it and reverse it. Even if it is not part of your business, just take it and reverse it. Or whatever is there in your whatever invoice and everything you have, just take it and reverse it. So that tomorrow anything of this sort happens, there is no problem of 16.4. At some point of time, it will get struck down, it will get diluted. And then you might not face that issue, or you never had put that in your books of accounts. So I think that strategy can be taken, but legally it is not correct.
One query though related not to today's topic, sir.
Yeah.
GTA provider opting 5% RCM, whether they are required to charge on their services provided to unregistered persons.
Now, GTA, if it is opting for 5%, practically then in that case, there is a liability under reverse charge. They practically cannot go under 5% at all. So it's like if it is under 5%, receiver would pay. If GTA is charging, they should pay to charge 12%. There is a view by saying that yes, they can still work under 5%. But if they do so under 5%, then I don't see an exemption which is there. And yes, no, there is an exemption in respect of non-business entities. So yes, they can take exemption in that regard. Yes, you're correct, sir. There is an exemption available in notification number 12 for that, sir. Okay, there is one question which has come privately to me. Can I take that question?
Yes, sir, please.
Is interest payable on ITC reversal even if there is an excess balance of credit in electronic credit ledger, that is ITC taken but not utilized? Absolutely no. In fact, even if you have wrongly utilized the input tax credit, there is no provision under section 50 for that, for a very simple reason. If tomorrow somebody has to issue a show cause notice to you that you are required to pay interest, they have to specify under which clause they are issuing the show cause. 50 subsection 1 or 50 subsection 3. 50 subsection 1 they will not invoke, because it is applicable only when you have short paid the tax and not paid the tax. In this case, you have already paid the tax, maybe through a wrong input tax credit. So it is not a show cause under 50 subsection 1. If they issue a show cause under 50 subsection 3, 50 subsection 3 is for the limited wrong availment and utilization which arises out of a mismatch of credits, through which mechanism is given in under rule 42 or rule 43, which is not in force right now. So frankly speaking, for wrong availment of input tax credit, there is a problem. There is no clear-cut provision through which the recovery of interest can be made. Though again, your case is clearly there cannot be any interest liability. So that is absolutely clear. For all those, in fact, who have used that wrong credit, still there is a very good case to argue by saying that there is no clear-cut provision for recovery of interest in this regard. One additional point is this, because the question has been asked, you can always look at from the point of view of saying that if in case somebody issues a show cause under 50 subsection 1 for short payment of tax, is it a short payment of tax? The answer is no. Why? Because when you read section 49, it says how do you have to pay tax, and it talks about that you can pay tax through your self-assessed ITC. It never talks about the correct ITC, it talks about a self-assessed ITC. So my self-assessment can be wrong. You can penalize me for that, but you cannot levy an allegation upon me by saying because your self-assessed ITC was incorrect, we will assume that you have short paid the tax. And last in this, it says that the manner of charging interest will be prescribed as per, and that 50 subsection 2 says prescription definition is given for prescription that it has to be through rules. I don't see any rule which clearly says that how interest has to be paid. Simple interest, compounding interest, monthly part thereof. So it is also missing. So we can also take a plea by saying that the interest provision, the manner of paying or charging of interest is also missing. Okay. I have one more
Next question is from CA Uttamchand, sir.
Yes, sir.
Sir, you may ask your question, please.
Good evening, yes.
Hello, sir.
Evening.
How are you?
Namaskar. At the outset, excellent presentation. You have
you,
gone threadbare. And my question is relating to the slum sale. What
Yes,
is the input which is available in a slum sale? I know that there is a provision which says that you have to transfer through a particular provision. But my intention of question is whether it is applicable for a slum sale, whether it is exempt or it is having some other application.
So how are you doing slum sale? That is important, sir. I mean, it's a whole business division getting transferred?
Yes,
or
division getting transferred.
Division getting transferred. So once you say it is a division getting transferred, and because it is slum sale, so you're not attributing value to the individual assets, then there is a problem, sir. The problem is then we have the transfer of business or part of it as a going concern that becomes an exempt supply, sir. Once it becomes an exempt supply, then you are not required to pay any tax on that. But in that case, I will not ask you to reverse input tax credit for a very simple reason that whatever credit you have accumulated till now, that is not attributable to this exempt output supply which you have made. So the simple answer would be you do a slum sale. If it is a transfer of business as a whole or part thereof, it is an exempt supply. Maybe any specific service which you have taken for doing so, you may have to reverse the credit, or whatever balance is left over through that ITC01 form or 2, whatever is the number,
04.
be able to transfer the credit, sir. There is no problem.
The second question is, there are many entries which are coming into GSTR 2A and which are either not related to me or I cannot take credit on that.
Yes.
Under that circumstances, what has to be done?
So I have a different strategy to this. I am of this view. At least first of all, maximize your possible scope of credit which you can take. That is, take the credit and reverse it instantly. What is the answer for that? The answer to that is, it was coming in my 2A. I took it and I reversed it instantly. So I never made any loss to the exchequer. But probably these are all those things whose invoices might be missing, or I might receive at a later point of time. Or for that, probably the transaction has happened, but I'm not aware. So as a precaution, I've done that. Nothing else we are required to do. So why am I saying that take and reverse? It might not have impact on a financial statement. It might not have impact in your GST returns. But you would see that entry of taking and reversing, so that tomorrow, if by chance I realize that out of 100 credits, 10 belong to me, but I was not aware, I would not reach the time limit. Otherwise, nothing is required to be done. You may ignore that.
No, but if you do what you are saying, if I take the entire credit and then reverse it, then it will not match with my books of accounts.
Absolutely, sir. It will not match.
And then I have another issue which is there in the audit report. I have to do something.
So how it will happen is, if I talk from GST and 9C perspective, it will always match. It will never be a problem, for a simple reason. It will bring my total credit as per books of accounts, which is net of reversals, and whatever comes from annual return is also net of reversals. So because net of reversal figures are compared, there will never be a difference in GST or 9C when I will reconcile my ITC as per books and ITC as per returns. When I will compare my gross ITC, which is there in my books of accounts, vis-a-vis the gross claim which I have made in my GSTR 3B, there is going to be a difference. When I compare the reversals of my books of accounts vis-a-vis the reversal which I have made in my returns, there is going to be a difference. So if I do it on individual basis, there will be a difference. But I have a justification for that by saying that because it was coming in my 2A, I did not want to lose that claim, because I am still not sure whether it belongs to me or not. And tomorrow you would say that I will not entitled to credit. That's why I'll take it. Department cannot allege that you have wrongfully done that, because there is no evasion of tax. The department cannot recover interest from me. At max, there is only a reconciliation at the back end. In fact, it will not come in face of 9C also.
Yes, can I raise a query?
Yes, sir. Please, sir.
Sir, during the course of deliberation, when it came for ITC on immovable property, you said that yes, today, as per going by the section, on the face of it, we cannot claim. But there are judgments in a particularly Orissa High Court judgment which says it is possible to claim. Matter is sub judice. In future, it may come in favor of the assessee. At that time, today, if I do not claim, tomorrow I may be losing that route permanently. So you said that either you claim it in your 3B, don't utilize it, and whenever it comes in your favor, utilize it. Or option number 2, you said you claim it and reverse it.
Yes.
Now, why should I claim and reverse? What is the advantage for me?
Yes. So it only has a limited point. Why? Because I don't want to invite a show cause notice from the department, which show cause notice will never stand against me. But what department will say, and that's the show cause notice of interest which sir just asked. So somebody asked a question that I have credit lying in my electronic credit ledger. I have never used it. Can department tomorrow ask me to basically pay interest and reverse that credit? So tomorrow department, let's say, says, boss, you have taken the credit, reverse it. I will litigate that matter by saying, no, I want to litigate it. They will keep on, let's say, that matter at the lower level would always go against me. But they will keep on saying, no, you are required to pay interest, you are required to pay interest and all those things. I don't want that particular unnecessary show cause where I keep that credit, keep on litigating unnecessarily. So better I take it, reverse it. Tomorrow in department, when there is a favorable judgment, I will keep it. There is no show cause in between. I don't have to unnecessarily litigate a matter because somebody else is litigating in Supreme Court. That's the only reasons. Otherwise, you may take it and keep it. There is no problem. There is no financial burden, but there is a litigation burden.
Today, I reverse it. Then after 2 years, can I again claim it back?
Yes, absolutely. Because you have fulfilled the conditions of 16 for once. Once you have fulfilled the conditions of 16.4, there are okay. So I'll tell you in what the context in which you're asking question. Can department tomorrow not say because you've reversed the credit, so now you have to again look at, you have to adhere to the time limit. So to answer to that would be that there are judgments in excise regime which says once you have taken the credit and reverse it, you have fulfilled the time limit of 1 year or 6 months, or in our case 6 months from the end of the financial year. Then whatever re-availment happens after later on, for that there is no requirement to look at the time limit again. If I remember correctly, there is in fact Madras High Court judgment only in this regard. I don't remember the name correctly, but it says that taking and reversing it is nothing else but transferring from one account to another, but the claim still exists.
Okay, okay.
Uttam sir, any more questions, sir?
There are questions which are coming. Already 2 questions have come.
No, from your end, sir. From your end. So
From
once
my
you
end
finish,
is over.
I'll take up.
Okay.
My end is over.
There is one private question, the question which has come privately from Mr. Jigar. His question is, there is a price drop of goods, say mobile phone, originally purchased at 100, price drop to 90. Manufacturer gives us such difference as price drop to me. However, GST effect is not given for such by them. Also, I am not given GST effect of such when I pass on such price drop to my customer, whether treatment is right. Okay, it's a price protection scheme. The manufacturer is saying, okay, even if it drops, basically I will reimburse to you. It depends what is the scheme. If the scheme is that you sell at 90, I will give you 10. Unfortunately, it is part of the consideration. You would be required to pay tax of rupees 10. If it is like this, even if there is a drop of 90, you pay it, whatever is there, I am assuring it that I will do it. I still believe that is still part of the consideration. You would be required to pay that. But if it is a 10 rupee which is coming as a credit note against the purchases which have been made and it has been pre-agreed, only in that case there is no GST implication. Otherwise, in all the other 2 examples which I gave, I see an implication of GST and you would be required to pay GST. Okay. There is a question from Mr. Anil Agarwal. Your brief comment on recent development in Section 50 with respect to prospective amendment. My brief comment again, to my limited understanding which I have, they could not have brought a retrospective amendment for this. They could have, but what I understood is that they had this legal challenge of doing it. Now by a press release, though it looks like a face saving, but probably what the lawyers tell me, and again, I probably would not be the correct person to interpret whether it could have come prospective or retrospective. But what I have understood with the limited interaction with them, that this is the correct way in which they have brought it. Now it is up to them how do they do that. Whether it can we say it the estoppel of a promise, they have breached the promise, breached the trust, all those things would be applicable. That is something for the higher courts to decide. But till the time that press release is there and lot of the GST law has been interpreted through press release, though press release have no legal sanctity, but I think it will be very difficult for courts to ignore the press release when 50% of the GST law has been interpreted to press release. So once the press release says they will not press for it, I don't think they will press for it. But yes, at least once this amendment has come prospectively, as chartered accountants, we can go back and advise our clients that all those who have filed late GST returns and paid taxes in cash, they should immediately pay interest, so that tomorrow they are not faced with the unnecessary nuisance. So at least on the cash component, all of us should be prompt enough to tell our clients that they should pay interest. Okay. Mr. Ronak Singhi has asked, why do you suggest take and reverse credit? Can you explain? But once reversed, you have no scope to claim back. I think I've
already answered now.
Mr. Anil has asked a question. Wrong availment of ITC could result in slapping 70 to 73. Wrong availment when there is wrong availment only to that extent when there is a loss to the exchequer. If there is no loss to the exchequer, then in that case, obviously no notice under 73. But yes, if you keep the credit under your records, then again for reversal, they can issue a notice under 73 or 74. So that's a possibility.
One question from my end, sir.
Yes, sir.
In the construction activity, we have a valuation rule where we get a deduction for land of 1/3 of the total consideration, yes, and sir, we pay GST on the balance 2/3. Now, this deduction that we are taking, will this be considered as an exempt supply and should be reverse input tax credit?
No, no, no. So why no? Because when you read the rate notification, it has a reference to section 15 subsection 5. What is 15 subsection 5?
Valuation.
Yeah, it says for specific supplies which are notified, the valuation will be prescribed. Though
Yes.
there is a goof up in the language, the way they have done it, there is a serious problem to that. But still, it's part of the valuation. This abatement basically comes from the valuation only, so it's a reduction in value. So this
Agreed,
is
sir.
no exempt supply.
Yeah, so I agree with the point that it is on the basis of valuation and not relating to reversal of input tax credit because it is only with respect to value.
Correct.
Now, in the books of accounts, there is a peculiar method in Tamil Nadu how we account the transaction.
Okay.
One, a sale of land will happen, undivided share of land will happen, and
Right.
next we'll have construction agreement being executed.
Right.
So for the purpose of GST from 1419, they have closed all the doors in the aspect of works contract assets and
Right.
everything has been summarized into construction services.
Correct.
Now, if I account a sale of UDS land in my books of accounts separately, though for the purpose of valuation for GST and returns and all, I'll be following the GST principles or GST rules. But
Right.
for the purpose of these books of accounts, if I account sale of UDS separately, sale of, the construction services separately, in that case, will it result in reversal of input tax credit with respect to the sale of UDS?
No, no, no. Very simply, no. Why? Because your exempt supply is governed by the provisions of CGST Act. It is not governed by how you do your accounting treatment. Exempt supply says all those supplies which are leviable or non-taxable or anything of that sort. Now, for this, your specific issue, I think this has already been taken care in the rate notification where they say even if the value of land is separately identified for the purpose of 1/3, you first of all bring it together and then you do that 1/3 reversal. So because even if you undertake two separate contracts for sale of undivided share of land separately and construction services separately, because you are paying tax after 1/3 abatement and you are following the valuation mechanism, your accounting treatment in the books of accounts will be respected, but only to the extent of Income Tax, Companies Act, RERA and all other things. But for the purpose of GST, it is not a separate supply at all. When if you take this from the context of GSTR 9C also, when you will reconcile your books of accounts and GST returns, so it will become an adjustment entry in when it talks about in that row number that table number 5. A difference due to valuation, that 1/3 you have to reduce there. So your total turnover will have construction plus land together, and then from that you will reduce this 1/3. But it is not an exempt supply at all, irrespective of how you record that in your books.
Sir, but if you refer Rule 42 for the purpose of calculating the exempted supply,
Right.
they are considering, they are saying that you need not consider the Schedule 3 items except for clause number 5.
Correct, sir.
Clause number 5 contains sale of land and subject to paragraph that is scheduled to construction activity, which is ongoing construction, sale of building.
Right.
So the specific entry, what it says is sale of land, sale of building, if it is on the immovable property side, that is post completion certificate, then it needs to be considered for the purpose of reversal under 42.
Correct. But sir, is it a transaction of sale of land simpliciter? Probably the answer is no. Because if this would have been a transaction of land, sale of land simpliciter, then you would not have done that 1/3 deduction. We cannot take true strategies for saying for recovery of tax, we will only give 1/3 benefit. But for reversal, we will treat it as a separate transaction. The color of transaction under GST, once it is decided, it will always remain same. So if somebody takes a view by saying no, it is a separate transaction for the purpose of exempt supplies, then for the purpose of levying of tax also, it has no nexus at all with the construction services. So we cannot be over conservative by saying that when we'll pay tax, okay, we'll include value of land and we'll deduct 1/3. But when we'll do it, go for the exempted supplies, we'll treat it as a separate supply. I don't think that would be the correct approach of reading this.
No, because land being state subject, you need to separately pay stamp duty for the purpose of land transaction. And of course, the disclosure in the books of accounts will have an impact.
Yes.
So
But
you
same
say
thing
that
applies.
disclose separately, it will not invite reversal.
Same thing applies for your slum sale, whatever talk you are going to do. Everywhere these issues will come. There will be a composite supply where everything will be mixed together, and there may not be a bifurcation per se. But when you want to have the land registered, you have to give a document saying that this is the rate, this is the value. You have to give a value.
Correct.
The same thing applies in even for income tax purposes, where you have to give a value, but there's no value.
Correct, absolutely, sir. So basically, the point is when you go to that Schedule 3 entry, it talks about sale of land. The point is, and it has a comma, sale of land and comma. So it is your transaction is not only of sale of land in that. Had this been a transaction of sale of land, then probably I would have subscribed to your view by saying, no. Then you take it in this manner. In fact, if I remember correctly, there is this entry in notification number 11, notification number 12 for this exempt supplies for services, and where what they say is that the value of land, whenever it is being supplied along with the construction services, it will be treated as nil for the purpose of exempt supplies. If I'm not wrong, probably I have to recheck it, but I'll recheck and maybe share that. So there is a value would be treated as nil. So maybe there also what they have done is out of precaution, they have said even if somebody wants to take this view, department side that it is an exempt supply, the value still in that case would remain nil. So I don't see that we have to take two separate approaches. Once you take 1/3 deduction, then there is no question of separate reversal.
One question from CA Ronak Singhi. Import of goods from head office out of India, payment delayed more than 6 months, ITC GST reversal required.
No, because you are in this case, payment to the supplier is important of his invoice. Basically, you are not making the credit is not related to the GST on the invoice charged by the supplier, but it is a credit on the bill of entry on self-assessment basis. So that is not covered by the 16th. So there is no problem at all.
President sir, any more queries?
No, sir. I have done, sir.
One query has come, sir. Suppose ITC credit of financial year 18-19 is awaited in 3B in September 19, but I have accounted the same in October 19. Okay, in books of accounts, is that right process? Can we claim it? No. This reverse process is very difficult, sir. I mean, you have not fulfilled the conditions of 16.
You have to be a smart accountant.
When you are filing a September return, at least close the books first of all, sir.
No, that you can always play. No, this is the ball, the banana story. This banana is the other banana because you don't give any breakup in 3B.
Yeah, that's a very good point, sir.
You don't give any breakup. So you say this banana is the other banana. The other banana is the other banana.
FIFO, you should always follow the FIFO policy in this case.
So I think we can move towards the end of the program. So thank you, everyone. Now it's time to bid adieu with a pleasant task of giving vote of thanks. Uncertainty is new certainty. Seamless credit has taken the path of say less credit. Let's hope that GST becomes really a seamless credit and we get the business and industry get the credit so that the business flows properly. So I sincerely thank the speaker CA S.G. Dadda for sparing his valuable time and covering up all the issues within the time slot provided and also answering all the questions very patiently. Thank you very much, sir. I thank CA Uttam Chand sir for connecting the speaker to ACA. Thank you very much, sir. I thank CA Kamlesh for the wonderful introduction of the speaker. And lastly, but not the least, all the participants who have turned out in large numbers to be with us for this program. Thank you very much. And thank you all. Please stay safe and use all precautions. Thank you and have a good day. We'll meet for the next webinar next time. Thank you.
Thank you, sir. Thank you, everyone.
Thank you, Uttam, sir.
Thank you, Bhaiya. Thank you.
Thank you, sir. Thank you very much.